Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. All right, welcome back everybody to another live stream. This is a big one. We've got NFP today. Shout out, by the way, to James for that new intro. Looks great. Sounds great. Dexter says they, or somebody said, yeah, Dexter said they're loving the music. GTA 6, May 2026. Yeah, no, it's, I love that intro. That's awesome. Anyways, as you saw in the intro there as well, don't miss the DNA Funded discount that they're doing. A1T20 will actually get you 20% off. There's a little bit of a low-key extra plug there for you. Link is in the chat and in the description of the live stream. So we have today, we have the unemployment data and, of course, the jobs added in the United States in the month of April. And this is a really, I can't stress this enough, this is a really important jobs report because we all know the double T's, right? Trump and tariffs. There's been all sorts of drama around this. And what we're looking at, right, when we think about what's going to happen today, the data that we're going to get is April's jobs, right? So April jobs, ask yourself, if you go back to March, tariffs were still kind of in the weeds, but April 2nd, quote unquote, Liberation Day, is where we saw true kind of clarity to a degree on tariffs and what they were going to mean, what they're going to mean. You know, there's still many things that are in development, but the point is we are going to get today's data for April, in which case we're looking at a set of data that includes all this tariff drama. Not only some data, we're getting the data, right? We're getting a key indicator of the economy, which is the jobs market. So what are we forecasting for today? What are we going to do if we get a better than expected or worse than expected jobs report? My goal in this stream and in my content today is to guide you the best I can through this jobs report. We're going to watch the reaction to indices, to gold, to currencies. And we're going to make some distinctive ideas or some setups, if you will, based on the data that comes out. So first, let's set the stage. What are we looking at? Well, we're looking at a forecast today. And, you know, these forecasts are made by the analyst community, statisticians. I don't know how to say that word. Statisticians, right? Mathematicians, Wall Street quants, a bunch of smart people try to make forecasts for what the jobs number is going to be before it comes out. You're talking JP Morgan, Bank of America, Deutsche Bank, right? All the big players try to make a forecast for what the NFP report is going to be ahead of time. Now, why does this matter? Well, it's all about the forecast versus what actually comes in today. Okay. So if you're somebody who's saying, you know, Nick, what's it going to be? Look, every single month for years now, I've been doing this exact stream where we prep for the jobs report and we say, what's it going to be? And every single stream, people ask me questions like this. What's gold going to do? Are the jobs going up? Are the jobs going down? What's it going to be, Nick? As if I'm some sort of fortune teller. And I just told you who makes the forecasts. The smartest players on Wall Street. JP Morgan, right? Chase Bank, right? Bank of America. All of these people who have teams of intelligent analysts make forecasts for what the NFP number is likely to come close to. Now, there's a couple pieces unpacked there. First and foremost, I don't know, and neither does anybody else streaming on YouTube or any other trader. We don't know this, right? So, first and foremost, if you are making a huge call on the jobs number being up or down in the next 10 minutes, that is gambling. You cannot sell me any other way. You don't know any better than the very intelligent people who put out this forecast. Okay. They have machine learning, quants, financial experts, everybody trying to get this number right. Guess what? They still get it wrong. So what makes you think you and I are going to be able to tell everybody what's going to happen to gold in the next 10 minutes? That's silly, right? So don't do that. That's foolishness. That's what newbies do, and they blow accounts because they get it right one time, and then the next time they blow everything. That's gambling. Do not do that. Okay? We're not trading the spike. We're not chasing. That's a quick way to lose a lot of money. You want to learn a quick lesson in trading? Try gambling on news events. It's not a fun time. With that said, what can we do? Well, if you're a fundamentalist like myself, we look at the macro as a story, okay? And what I mean by that is that we're going to get this data point today. The actual number is going to come out. So let's map out what that potentially could set into motion. What kind of trends could form? Where does that fit into the overall macro context? That's what we're going to do here today. We're going to be smart about the COT data. We're not going to be idiots gambling on the spike. Don't be that guy. Every month there's a guy like that, and every next month he's gone because he blew his account. Don't be that person, okay? Let's not do that. Let's talk about what we're going to do if the number comes in at 110. Or what if the number comes in at 160, right? These are going to have huge impacts on the market, okay? Let me ask you guys, I'll give you a chance if you're a regular to answer this question. If you get 160,000 jobs when the forecast is 138,000, how does that impact the dollar? Just real quick, type in the chat. This is your chance to quiz yourself, and I'll tell you the answer. Okay? The answer is, ready? If the forecast is 138K, number comes in at 160K, that would be strong for the dollar, weak for gold, and stocks are difficult. Stocks are a question mark because it depends what's happening with inflation. I'll tell you today, strong jobs, strong stocks. Because people are worried, especially right now with all this tariff uncertainty, people are worried that this is going to happen. People are worried that the labor market is going to slip and slide and the Fed's going to need to step in and save the day. That's what people are worried about. So in that environment, what about this? What do we do in this situation? Dollar's probably headed lower in a weak print. Less jobs than expected added, weak for the US dollar. Gold would probably have a good day. Stocks would sell off. That's my base case for the non-farm employment change data that's about to come out. Now, Nick, does that mean that if we get 110, we should just go rip the Band-Aid off and short the US dollar and long gold no matter what the price is? No. This is all context. This is story, right? Put some work into this stuff. Many people just look at news events as like gambling events, like a roulette table set up for them to lose money on. Don't do that. We look at this from context. If we get 160,000 jobs, let's fit that into the story. What is the story? Well, the story is, let's go over here and let's go to our economic heat map. By the way, guys, I'm so excited to show you this. We just finished something. The economic strength gauge for currencies. If you're a currency trader, boom, bam, thank you, ma'am. This is awesome. What this shows you is the strength of currencies, right? So right now we have some weakness in the US economy, and this is specifically based on hitting or missing forecasts, just like we got done discussing. It's all about forecasts. It's all about actual data. About this chart, you can read about this. Feel free to pause the stream if you want to read about this more. But this will show you, have economic data points been surprising to the downside, like the US dollar, or have economic data points been providing some upbeat strength, like the UK, right? That's what it's all about. This is one of my favorite new charts that we just recently added to the Edge Finder, and it's a really exciting one. So when we look at the jobs report number today, right, the US dollar has been under some serious pressure here recently, right? We take a look at the US economic heat map specifically, we get a good picture here, right? Wage growth last time around was pretty soft, right? We saw unemployment rate rise last time, also soft for the dollar, right? We can see the US dollar impact, bearish, bearish. Jobless claims, this recent report was bearish for the US dollar. Jobs data across the board has been weak, right? So as we come into today, it's a huge report. We need to see some strength for this dollar to hold out. Otherwise, if we lose this, that would be an all red labor data report. Not so great. So we'll see what the data comes out. That's why it's so impactful. We've got just a few minutes to go. I want to ask a quick favor to everybody who's watching right now. If you're enjoying this stream, if this has been helpful to you, I noticed I used to watch NFP streams for a year or two before I started streaming myself. And what I noticed is that most of them never would actually break down the data, right? People are just like, oh, NFP or CPI, it causes a spike. Let's trade the. My goal with this stream is to help you actually understand what you're looking at. What is this data telling me? And what does it tell me about the potential trends that are going to take place in markets? If you're enjoying the stream, hit the thumbs up button. I greatly appreciate it. So let's talk strategy. If we get a good jobs report today, I'm going to probably be looking for more upside on risk assets. I'd be looking for any sort of pullback on the S&P, any sort of pullback on the NASDAQ. I'd be looking for longs on Bitcoin on a pullback, right? Risk assets would love to see a strong jobs report to end out this week on an up note. Will we get that? We don't know. If the jobs report is horrendous, right, I would say we probably are due to give back some of our gains this week. NASDAQ's up for the week, guys. We've had a good week for NASDAQ, largely in due part because of strong earnings, right? Meta, Google, these companies had really good earnings. Apple actually had good earnings, I think. Let me just double check that. Yeah, they had great earnings, but there was something the market didn't like as much. I'm not fully up to speed on Apple, but still, they had good earnings, and that's a good signal for the economy. NVIDIA's been ripping here off of their customers reporting earnings that look good, right? Meta, Microsoft. Oh, that's another one, Microsoft. These are companies that have reported their earnings and come in very strong. That's propping up the market this week, right? That is a huge positive for index traders. What about gold traders? What's going on? Well, we've seen some pullback here, right? We've come down to this support level. Let's see how this one either holds or gives out today. You have the potential that if you get a really strong NFP report, we've already seen Ukraine and US making a deal. That was a bearish catalyst for gold. We could see further decline on gold if you get a strong labor report today. It's pretty much, in my view, if you get a weak jobs report, gold's probably going to bottom out here. And that would be my best guess based on today's key economic data, unless something drastic changes in the headlines or some big announcement. Putin does this or Trump does that, right? Those are potential market movers. But guys, we've got 1 minute to go. Like I said, if you're enjoying the stream, make sure to hit the thumbs up button, subscribe if you want to come back. We do this every single major news event. And if it's been helpful, I do want to just ask that you consider subscribing. So don't go anywhere after the spike. This is the next thing. Most of the time after big news spikes, people leave the stream. And it's like most people want to trade the spike. They want to gamble on the spike, but stick around after, because that's where we actually look for trade setups. I trade the aftermath, not the before. I'm not trading the spike as spreads get ridiculous and you're likely to really get yourself in a world of hate and pain and suffering trying to gamble on what the news spike is going to be. We don't know. Let's wait for the data and let's interpret it together. So again, coming in, we've got just about 15 seconds to go for our breaking news coming in just a second. So just a heads up too, as we wait for this number here. We also are going to be looking at average hourly earnings and unemployment rate. So let's take a look at what we got. So waiting for that report here. Initially, S&P, NASDAQ, Russell up. Dollar index slightly up as well. Let's take a look at what we got. All right, 177K, guys. We got a good print here. Average hourly earnings went down, right? So that's a little bit of soft data for the hourly earnings. And then unemployment rate stayed the same. So how do we rate this? Well, overall, I would give this is a great point. This is actually also good for the inflation story, right? Labor data or average hourly earnings coming in a little bit soft means people getting a little bit less wage increases than forecasted. I know that's not great for the people who didn't get wage increases, but it is great for the inflation story, right? Because people getting wage increases is inflationary. So we see NFP came in real strong, very nice there. However, we did get a revision lower on the previous number. So some mixed there. Strong NFP report here, right? We were expecting 138K. So this was actually pretty good. I'd give this a B+. B+ overall in terms of a report card for what the market wanted to see, right? B+ to A even. Pretty close. Nice solid number. We see a market reaction here. Gold down here on this number. We see dollar index up, stocks up, oil flat, and Bitcoin kind of flat as well. Not too big of a move in either direction. So let's break this down. What does this tell us? Well, it tells us that jobs data coming in here is not mission critical, right? People have been so worried about like, oh, you know, tariffs are going to, all the CEOs of the world are going to stop, all the CEOs of the world are going to stop hiring, and they're going to freeze hiring, and everything's going to, HE double hockey sticks, and it's all over, right? People have been so scared of all the tariff stuff. But what we see in actuality is earnings and jobs this week. Ready? They were good, right? Despite the market freaking out. This is classic. This is classic market psychology. Everybody convinced market's going to crash. Companies are going to start laying people off in mass, and tariffs are going to drive inflation to the moon. And what do we have in actuality? This is where the hard data matters, guys. The hard data tells us jobs got added more so than expected. And what do we know about inflation? Inflation's down. Inflation's at 2.4%, right? PCE's at 2.6, PPI 2.7, CPI 2.4. All of the inflation readings are looking relatively okay. So context matters here, right? Because again, the market will tell you, the market has been telling you, oh my gosh, everything's going to crash. Trump's going to ruin the world. And again, whether you like or dislike Trump's political views, this is where I say it doesn't really matter from a trading perspective. Leave that at the door. It will only do you harm if you trade with your politics in both directions. If you love Trump and you put your whole account into longs on calls on the S&P 500, it's been a painful year, right? If you hate Trump and you said it's going to crash and he's going to ruin everything, and I know it, and then the market ripped, it hurts you, right? So leave your politics at the door. Please do yourself a favor. Otherwise, you're just going to really regret it. The main point is let's look at the data, right? What did data tell us today? Jobs look healthy enough, right? That will do. Let's take a look at yields, right? What's the response? Well, yields market is telling you that was a strong jobs report, because if this was a bad jobs report, yields would be lower, suggesting the Fed's going to cut rates. The rates going up, yield going up, tells you the Fed is now less likely by a slight margin to cut interest rates as quickly this year. Really, really good stuff. Again, that is a positive catalyst. Taking a look at the NASDAQ, taking a look at the S&P 500. NASDAQ looks like it might be headed up to try and test this 20,400 level. I've been personally looking for an opportunity to get long the NAS. Trade setups for me in terms of NAS setups are definitely still this idea here. I do think that we have room to continue to go higher. I think a lot of people got duped this year, to be completely honest. They thought the market was going to crash. And then what happened? They bought puts, they sold their stocks, and boom, we have already, doesn't even feel like it, we've already retraced 61% of the sell-off. like that quick. The sell-off reversed course very quickly. And that's how it typically happens, right? Typically what happens is people get very bared up and they think, oh, this thing is going to crash. And then when it goes up, they say, no, it's going to take out the low. It's going to go lower. And then they just keep, staying in that denial phase. And then they're just all of a sudden they've missed the whole rally, right? So just really important that if you are somebody who again, you're a human being for liking or disliking a political figure. But a lot of people, what they do is they make the mistake of trading their politics. And if you made that mistake this year, forgive yourself and then don't do it again. Okay. Because it really is a silly thing. Right. I mean, the thing is, the bond market, right, freaking out when this all happened. And some of the key, financial leaders, Bill Ackman and Jamie Dimon, right, all these key, financial figures. Jamie Dimon's the CEO of JP Morgan, right? These big players came out and basically said, yeah, this is going to seriously question the strength of U.S. debt, and that freaked the market out, and it freaked the administration out. And I think that's part of the reason why they backed off kind of the aggression on some of the tariff stuff, and hence why the market has continued to rally higher, right? So it's been interesting to watch all that. That is a key player. But again, all of that drama, all of that tariff noise, it is valuable, don't get me wrong, to keep an eye on it. But in my perspective, and what I've done for years, is I stay focused on the heat map. I stay focused on the economic data because, again, there's a lot of noise. There's a lot of chart jumping up and down and news headlines that freak you out one morning and then they sound great the next morning. But the data is the data. And this is why we focus on this channel very heavily on just understanding our reports here, because this is where the data falls. You get all this noise on the headlines, CNBC, CNN, Fox, all that stuff. You get all that noise, right? But then where it actually lands in the CPI, where it lands in retail sales, where it lands in today's number, the NFP report, that's the stuff I trade based on. Because I look at that and I say, this is the story. The economy is XYZ. Is it an A plus? Is it a B? Is it a C? Right? And then that's what I trade based on. So I just wanted to share that with you. Also, just going back quickly to this new currency economic strength chart. So what you want to know about this is if you have the Edge Finder, you've already got this. It's under your economic heat maps. Just go to currency eco strength. And what this is doing, and I want to change this because really it is strength, but it's more so focused on surprises, right? So what this is showing you is that if the US or the UK or Europe or whatever, if they are having really good numbers relative to forecasts, this speedometer goes higher, right? So I'll show you what I mean by that. So if we take a look at the US, it's a 36%. What does that mean? Well, go to your US economic heat map, and you can see we have a 36% US impact right here. That means that 36% of our indicators that we're looking at, retail sales, PMIs, et cetera, 36% of them are positive for the US dollar. The rest are bearish. So that's a very low score. So when we go back to our currency eco strength, we wanted to make it a way so that our users can see all of the readings on one screen. So kind of an exciting new addition. Frank did a great job. Frank and Giles did a great job, our dev team. But this is really exciting to me too, because if you are a currency trader especially, this will allow you to very quickly get a general idea of economies that are looking upbeat relative to forecasts versus downbeat or weak. So yeah, this is, like I said, it's a new indicator within the Edge Finder under economic heat maps. If you have the Edge Finder, it's a free edition. We don't upsell you for new features like this. If you do not have the Edge Finder, get a copy because the sale is ending. We're currently doing 45% off. It's our biggest discount that we do all year long. And if you'd like some information about that, what we'll do here is I'm just going to drop a link in the chat as we speak. Hold on. There it is. Click this link here. If you don't have the Edge Finder, send us a direct message. And while the stream is live, we'll give you 45% off. It is our biggest discount that we do all year long. And yeah, we've got more features coming. We just keep rolling out new stuff. This was a feedback. Actually, this was an idea from a customer, from one of our users on the Edge Finder. They were like, I would love to be able to see the heat maps in a kind of like an overall heat map, like a collective heat map. And this is pretty much that. It allows us to look at the economic strength of all of our readings on one screen. So kind of fun. Hold on, I want to read this. Alan says, I had the craziest dream last night. Nick did an emergency stream in the middle of the night because mortgage default skyrocketed. I woke up and immediately checked my positions in a panic. You never know. Maybe that will happen in the future. The markets are crazy. So based on this chart, you can kind of see visually why recently I've been more on the concern side, the more bearish side when it comes to the US dollar, and why I've actually been more favorable towards pound and UK. What you'll see is a lot of stuff has actually been on the lower end. The strongest of the list here, the two strongest on this list are actually Kiwi and the British pound. Does that mean they have the strongest economies of the world? No. That's where people are going to get confused on this. But it's really important that we make this distinction. The pound and the Kiwi relative to forecasts have been kind of upbeat. They've been strong relative to what people in the analyst community expected about them. We can see those data points by going to the New Zealand economic heat map and breaking that down if you want to get more understanding of that. But for those who are, aspiring fundamentalists, this is so powerful because, again, fundamentals are just hard to try and get all the data in one spot. And we are doing our best every day on the A1 side of things to build those tools to help traders take that stuff to the next level. Anyways, NASDAQ's running away from me, so I'm going to look for pullbacks on that one. My stock positions probably look good today, but I would like to get in on a NASDAQ pullback if we do get it. VIX is down 7.5%, squeezing out some volatility crush, if you will, following the NFP report, as now some of the implied moves of the day are probably behind us. We've got DAX moving higher here. Look at that, 1.7%. Russell's doing okay this morning. You've got dollar index lower here on this. Interesting. Look at what happened to the dollar. What's going on here? Dollar index, is that accompanied with yields? No. Okay, wait up. Hold on. Yields are up. Dollar is down. Let's break that down. What's going on here? Bonds lower here this morning. There must be some nuance in the report that I'm not picking up on immediately. Really interesting, though. So, again, let's recap what we had here. NFP was strong to a degree, and then you had a mix in the revisions. Unemployment rate stayed the same. Average hourly earnings went down. Or they didn't go down. Let me say that better. They went up, but at a much less pace than people thought. So let's just take a look here, see what the Fed tool is telling us now. So pretty much a 98.7%. And if we take a look at June, we are now slightly favored to actually hold interest rates steady in the June meeting. So what this tells you is that the first kind of easy answer of when a rate cut is likely to come by is July 30th of this year. So the July 30th meeting is expected to be the first time we actually get a rate cut. Now, June is a maybe. June's 50-50. July, according to the bond market, right? June is 50-50. May is pretty much off the table. July is the first time where we're like, okay, yeah, we probably get a rate cut by July. Pretty strong chance that we get a rate cut by July. But again, what I would say in response to this, right? People have been really claiming that there's going to be a recession, that's happening. Well, the difficulty with trying to claim that there's going to be a recession is this does not scream recession. There are some weakness points to look at in the US data, don't get me wrong. But the NFP report is a big one, and it doesn't really suggest huge probability of a recession, at least not yet, right? And again, I study this stuff every single day, and I cannot tell you with certainty what it's going to do next, right? Nobody can. So when people tell you with certainty that a recession, like a lot of people are out there, they're like, oh, we are going into a recession. I'm very confident we're going into a recession. I mean, maybe we do, but it's going to be a very, people have tried time and time again to call the timing on recessions and been very wrong. Did you know that in 2022, somebody actually made a comment on my YouTube video yesterday that I thought might be worth sharing with you guys? So I had somebody comment on my video that they thought that the stock market was going to go down or something because JP Morgan thinks so. Or Bank of America. They said something like that. They basically said, I trust the big banks that make the decisions. And I had to fact check this person because I want everybody to be careful with that stuff. Some of you guys might have heard that Bank of America, the B of A, right? Bank of America recently they literally put out a statement saying short the S&P 500. I am not kidding. You can go look that up. They said short the S&P 500. They said it over here. Okay. The market's up since then. Could they have been early? Maybe. But the point is this. In 2022, JP Morgan, with all of its wisdom, all of its knowledge, all of its intelligent people, all of its mathematicians, quants, financial geniuses, right? With all of that knowledge that they had in 2022, they said that the market in 2023 would be down. Sorry, hold on. They said in 2023, the market would be seeing a minus 20% loss in the S&P 500. Do you know what the S&P 500 did in 2023? Again, fact check me. Go look this up. I'm telling you, it's a very important lesson that we all acknowledge this. JP Morgan put out their year-end target for 2023, down 20%, quoting that a recession was imminent. Do you know what happened next? The market went up 20+%. Think about this. They said minus 20, the market went up 20. That's a 40% difference. This is the biggest bank in the world. The biggest bank in the world said that the market was going to fall 20% and that we were going into a recession in 2023. What happened? The market absolutely reversed and did the exact opposite. Okay. So my point with telling you that is that even the smartest, even the greatest minds, JP Morgan has a lot of smart people there. Like I'm not saying, they're just idiots over there, right? They're smart people. It's just the market's hard to predict. Even the greatest players at the table can get it wrong, right? Plenty of times they're right, but not always. Nobody's always right. So it's just something to think about. It's the challenge of markets is significant. Okay, guys, we've got, in just a second, we're going to have Kenzo joining us in the call. Before I do that, let me just mention really quick one last time that if you do not already have access to the Edge Finder is currently 45% off. We're coming to the close of our sale event, celebrating 3 years since we initially launched the product. If you don't have access to the Edge Finder and you'd like to pick it up for the lowest cost of the year, that is the best price that we're doing all year long. Click this link. It's been dropped in the chat, or head over to a1trading.com and you can live chat with our team in the bottom right hand of the screen. Okay, guys, in just a second, I'm going to bring in Kenzo here. I am going to do this transition myself, so just give me 1 second. It's going to be a little, the producers are not in the stream right now, so I'm going to be doing this manually myself, which you guys know I'm not the producer, okay? I'm just the guy who dances on camera. So I'll be right back with Kenzo in just a sec.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now, back to the A1 Trading Show.
All right, we're back with Kenzo. Hey, Kenzo, how are you?
I'm doing great. Thanks, and you, man?
I'm good. It's good to have you back on the show. Kenzo, last time I spoke with you, the markets were much lower than where they are now. We had some ugly last couple of months, but we've really bounced back and actually ended out, believe it or not, in April on the S&P 500 and the NASDAQ. We pretty much came back all the way to break even, despite being down at one point for the NASDAQ upwards of 15% on the month, which is a crazy drop. It's been a wild turnaround, and I'm curious your thoughts on the indices. Are you bullish, bearish, cautious? What do you think?
Yeah, actually bullish, but not 100% because it's all about fundamental currently. But I think that sell-off was also a boost for new guys to buy some shares, because all these shares were actually affordable, or some stocks were actually affordable. So I think that it's actually a boost. And we slowly see Trump starting to cool off on the tariffs. Maybe one way or another, China and US, they will have to sit on the table. And it seems like it's going to happen, even though it might not really be now. And I think that is actually good for the stock market.
Yeah.
Another thing I saw, I think Trump and Prime Minister of Canada, I think they scheduled a meeting together. I think that will also soften the tariffs, and that is going to be good for the stock market. So I think we are going to see some reversals here and there.
Yeah, that's a great point. We are seeing, like you said, several kind of countries come to the table, want to negotiate with the United States, wanting to make deals. And I do think that there's also, both sides of that, right? The U.S. also backing off a little bit on the aggression towards China, maybe playing a little bit softer rather than just kind of threats and aggression. We're seeing a little bit more on the negotiation side, which I think is what the market ultimately was okay with, right? Tariffs, themselves are simply tools. Trade negotiation is not the end of the world. It's the way that the Trump administration kind of came out swinging first that really kind of scared the market. And now we're starting to see a little bit more of a slowdown of that process. And clearly the indices really like it. Now we're grinding higher here. And that big 90-day update, I've been talking about this a lot. That big, 90-day pause announcement was this ginormous candle on the NASDAQ. And then the market kind of fizzled out and faded. But now that we've recaptured that area, that key level has actually become a floor of support. So I'm wondering, do you think that this market move has, from here, do you think it is possible or more likely that we see kind of just a continuous kind of very sharp retracement back to the highs? Or do you think that there are going to be some drops in the meantime? Do you think we'll see more pullbacks? And if so, how would you be looking to enter the market, since you mentioned you're leaning bullish but still cautious?
I think at the moment I will be way too cautious, because those resistance zones that you have marked there, they are very important. The only thing that it's pushing or stopping the market, I can say it's actually China and US. But one way or another, we see that they won't survive. Both of them, they won't survive these higher tariffs. So they will actually make that deal. And if that happens, I can say, yes, we're going to reach those 22,000 there. But at the moment, I think the market will be respecting every level. I think the market can reach the first I think it's 2,400 there.
Mm-hmm.
The market might reach that, and maybe we might see a respect there before maybe we see a nice push. But if maybe we have a deal very quick, I don't think we're gonna take much time to reach the highest level.
Yeah, and Kenzo, this morning, obviously, we had the NFP report come in. What was your thought on the report?
Not really bad. Not really bad. It's actually good because the number is not really that crazy high and it's not actually low. At the moment, the recession and stuff like that, we don't really want inflation to go higher and like that. So I think the number is it's not really that bad. So that's why we don't really see much reaction from the market. I can say it's balanced because you can see hourly earnings went a little bit lower, but at least unemployment rate did not really go anywhere, still the same as last month. So it's not really a bad thing.
Yeah, and to your point, so we had unemployment rate stay in line. We had the NFP report come in better than expected, and they did revise the previous number down, and then we had a slight miss here, and like I said, the revision. So overall, a pretty good report. Definitely not the doomsday that perhaps some people were thinking we would get a big miss, right? Some people thought we'd get like a sub 100,000 jobs, and people worried about recession. If we were really clearly nosediving into a recession, I think you'd get like an abysmal number, like a 75K, or like you would have gotten like a bad number. But we didn't get that today. We got a pretty solid number showing that companies are still hiring. And Kenzo, we haven't talked about this yet, but you mentioned some of the stocks that kind of went on sale here recently. We had a couple earnings reports that were actually quite good. Here's Meta, which had very strong earnings. I know you and I talk about Apple a lot. Apple had a really good earnings report as well in terms of simply their earnings and their revenue, right? We beat on top and bottom. And then we had Amazon, which also had good, strong numbers, beat their earnings pretty substantially, really good. So all the big US companies, the big US magnificent companies, are coming in with pretty good earnings despite all the fear out there.
Exactly. So, and that it's something that is still brewing. So, which means the market, maybe next week or the other week, we might see the market explode to the upside. So, I think the only thing that is holding the market, we can say, is those tariffs, because the earnings reports were very good. So, it shows that the struggle is not really that much, or at the moment, we don't really see any cracks. But I think one way or another, that has to we have to see something happening on the Nasdaq chart or S&P 500. But everyone is still going slower, which is good because it gives us a chance to understand if maybe this bullish momentum is going to continue or not. And once those news come in, I think the market is going to break some new highs.
Yeah, and I think there was one other thing. We've just gone through a list of reasons that the market is feeling a lot better. Earnings and the jobs report here today, and we forgot to mention another really good one, which is gold gave back some of its gains largely because the Ukraine and U.S. deal that was made. Seems like there is progress. I read a report yesterday saying that's a pretty good omen for peace negotiations with Ukraine and Russia. So, you're seeing some things come together that the market clearly is very excited about. Good earnings, jobs data coming in okay. We have this rocky road we're still dealing with the tariffs, but I think the bear case has really substantially weakened because, again, it seems we've also had the administration respond when the market absolutely freaks out. So there seems to be a Fed put in the form of they'll step in and cut if they need to. There's the Trump put, who doesn't want to see the stock market go down clearly, or even more so, doesn't want to see the 10-year yield jump too much. So the bond market's kind of holding him in contempt. There's a lot here, in my opinion, for reasons for why this is actually still a buyable dip in my personal view. But from a technical perspective, I do think you're correct about some of these key levels. We are still in what has been a traumatized market. So I do think that as you get up into these levels, like 2,400, as you said, these could act as barriers. We could see retracements. We could see, things that shoot it back down in the lower time frames. But for me personally, this is still a buyable dip on retracements that I'm looking to take advantage of.
Yes, this is actually a good, I can say it's still a very good area because the market was still very far. Before we get all this reversal, the market was like seriously far from where we are. We can say we are halfway towards that higher level. So we can say that it's way too enough and the market slowly will creep, slowly going there. And it won't just go with a one candlestick, unfortunately. So the market will go slower there. But maybe next month we might be around those zones because we have some serious good news. And another one, the one that you have mentioned, Ukraine deal, it's actually a bigger one because those resources that they signed to, there's a lot of them, rare earth materials, even oil. I saw oil was selling, trying to actually to recover, but if we check very nice, all those rare materials, they are going to be a little bit cheaper for the US, which means even inflation is going to be quite lower. So at the end of the day, I think now US, they can actually recover the funds than just printing those dollars. And that is actually a good thing. So at the moment, I think, the only issue now I can say it's US, China, and maybe the last negotiation with Russia. I think that is just going to be, once they get that done, I think it's going to be a very good thing.
Yeah, no, I mean, well put with the Ukraine, obviously the minerals deal, anything that causes more supply to flood the market, whether it be raw materials, agricultural goods, commodities like oil, copper, iron ore, all that stuff. When there is more of that brought into the system, more liquidity, if you will, in terms of commodities like that, it's a positive thing for inflation, right? Because inflation really gets out of control and out of hand in environments like 2022, where we had war, where oil supplies were all sorts of up in arms, or in 2020, where the global pandemic really caused supply chain issues, right? So those things are very inflationary. So it's a good story for inflation to have wars stop and trade continue to flow, and of course also to have at the end of the day, deals made. I think that that's another thing that the administration knows. They know that trade negotiations, they may be taking a softer approach because they saw the not so great response to the hard attack, right? The hard approach. Now they're going a little bit softer because trade negotiations are huge to the inflation story, which is ultimately like centerpiece. That's what really, I think, the election last time around was all about. It was about, during the election, it was all about inflation. That was a big, big, big component to the economy. People worried about prices getting out of hand. And so I think the administration knows that if they follow through with just super hardball tactics on tariffs, it could be inflationary and it could hurt the consumer. So, it is still a risk, and we'll have to see how all that plays out.
Yes, I think at the moment, we still have that risk, but I think it's now getting smaller and smaller. And also, I like the fact that now it seems like Trump is going to think twice about China tariffs and stuff like that. And slowly, unfortunately, they can't just mention everything. I think maybe they're just trying to do some research on the stock market or other things, because at the moment they're still holding those tariffs, but the market is not really crashing. They might hold and see if maybe how long will this continue? Are the business suffering or something like that? If maybe they see the damage, I think slowly they will start to pull out from those tariffs. I think they also mentioned this, that they can't actually survive or continue with higher tariffs like that. So they have to come to the table. Plus, if they come to the table, we have other deals like US Ukraine deal, which is very good, I think, going further. And with that, I think it's going to force Russia to also come to the table. because now it means US is going to be more involved, because now they have the deal with their with Ukraine. That I think slowly we are going to start to see gold maybe starting to struggle a little bit. It might start to go a little bit lower because the demand, or maybe the tensions, or maybe, yeah, those tensions are going to start to cool off. Slowly we might start to see gold starting to cool off, and that would be good actually.
Yeah, I mean, it is in terms of the overall market perspective, gold dropping is a good thing, right? It signals that maybe some of that peak fear, that certain uncertainty that we saw in markets is starting to relax a little bit. And as you mentioned, if you get, Russia negotiating with the U.S. further, and as you pointed out, U.S. and Ukraine relations kind of intertwining more, back kind of aligned again, definitely means like, okay, Russia's now not just dealing with Ukraine and Europe, but they're dealing with everybody again. So it's like, okay, that is a more stability to the realm to some degree, and that brings gold lower, right? So just remember, to everybody in the audience, gold thrives on that uncertainty, war, fear, massive inflation, hyperinflation, economies crashing. These sorts of events make people run to gold. But just like people can run to gold, they can also dump it or get rid of it when things look a lot more stable. And I think that you are seeing some stability. So I actually had a gold long position. I traded this run up in gold prices, and then ended up taking profits after we closed here. I entered again and then took a loss, a smaller loss here. So I'm no longer in gold, and I don't have a reading at this time to be long gold. Do you have any trades, Kenzo, on gold, or any ideas? Would you get long if it were to retrace further? Do you have any positions? Would you get short? What do you think?
Yeah, I actually have some positions on indices,
Mm-hmm.
yeah, Nasdaq, S&P.
Mm-hmm.
On gold, I was actually scalping, and I can see that it's little bit struggling. And I think if it breaks that support, it means I will be out,
Mm.
because that was also a very nice area for a smaller support. But with the news that we start to hear, it seems like it's gonna be a little bit difficult for gold to reverse. But we'll just actually watch and see. But I can see it's like 1, 2, 3, or we can say almost a week where gold was actually struggling.
Mm.
Because if you check before that, it was moving very nice. After that, we start to see the struggle. Yeah, and if you check also VIX, we can see that the panic is starting to cool off. So that shows the confidence. And yeah, if you see gold VIX going down, I don't think it's a good thing to be holding gold for quite long.
That's a great point. Typically there is some overlap when you get a lot of fear in markets, that
Mm,
can equate, not always, but it can equate to rushing in of gold as kind of that alternate. And it really worked. The trade really worked. VIX long, gold
mm,
long recently, because there was a big sell the US trade, and that meant lower dollar, higher gold. It
mm,
meant sell US treasuries and buy the alternative. To gold, to treasuries, which is gold. Oftentimes I mentioned that, like, TLT, which is a very popular bond ETF for stock, or
mm,
investors, they can buy the TLT, which is like US bonds, or they can buy gold. And there's times to buy each one of these. This is actually a favorite topic of mine, because
mm,
with US bonds, right? US bonds, with US bonds, you get something just for holding that, right, Kenzo? Like, we get paid if you buy a US bond, you're getting paid some amount. Like, let's say it's like 5% per year. Like, every year, just for
yes.
having your money invested, you get 5%, and that's what you're going to get. And a lot of people in like retirement, or funds that have billions of dollars, like, they'll just park some money here and collect that 5%. Now, why is gold an alternative to that? Well, gold doesn't yield anything. It yields 0%. However,
Mm,
it typically thrives in the same environment that bonds would thrive. Like, bonds go up a lot of the times in the same environments where gold goes up. When people are fearful, They rushed to bonds. But the reason gold
Mm,
did so well recently in all this is because people actually said we don't want U.S. bonds because the U.S. is kind of the question right now. So this
mm.
being the comparable alternative got really attractive. Gold got like doubled up. That whole crowd that buys these combinations, like they buy bonds, they buy gold, like the defensive crowd, the option for bonds was like not a choice. People went right into gold. So just something to think about. Kind of an interesting flood of capital into gold for that reason.
Yes, I think on that, on US bonds, I can say it was politically motivated. It was not something that happens every day because when things are not really going well, bonds are quite safe
Mm.
because it's like loaning the government. One way or another, you're gonna get your money back. So, and it comes with a certain percentage or let's say interest rate. So yeah, at the moment it was people, let's say politically, when we say Trump is doing some sketchy stuff, that gives investors doubt to say why should we hold US bonds,
Yes.
because it seems like they're gonna change their terms like every now and then, and that is not really a stable thing. Yeah, that's why I think after US yields went lower, I think Trump panicked and said, you know what, we're going to pause tariffs for 90 days. And then they did bounce back. Because if you see bonds going down, it means there is someone who is selling. And most likely it's those countries, bigger countries, they also hold those bonds. Even people, they do that. But mostly you're going to see a different with the governments. So if they sell, that is not really good because it's like they're losing interest or they no longer have confidence with that country. So, but now I think maybe slowly we saw smaller reversal. Maybe we'll see that continues over time. But for now, I think everything slowly is going to recover.
Yeah. And again, kind of seeing some flight away from both areas. You can see bonds lower here today, gold also lower here in the last week or so, as people are now saying, okay, maybe I want to sell risk off and get back into, risk on. Again, Nasdaq's ripping here today, 1.7%. You said you have a long position on Nasdaq, Kenzo. That's awesome.
Yes, on S&P and Nasdaq.
Okay, awesome. I'm jealous. I wish I
I,
was.
I thought US data is not breaking. If you can check US data, I think it was under. Okay, I think now it's now breaking because I thought it was still under the resistance. Now it's out of that. I think I will also check that out.
Yeah, the Dow is in terms of the bounce back has kind of been lagging the other two. Like Nasdaq's been really, really strong. Like if we take a look at
Mm,
here's Nasdaq, S&P 500, similar. Dow Jones a little bit weaker in terms of like if we're using our reference point as the 90-day pause
mm.
announcement day, that big green candle, there's Dow, there's Nas significantly higher. There's
Yeah,
S&P
it's
also significantly higher. So we're seeing some nice bounce back in all three, but that relative strength seems to favor Nasdaq and S&P. So very nice trade. I wish I
exactly.
had that too. I almost so I was looking at the Nasdaq, Kenzo, and I almost entered like I was waiting for a pullback and I was so close right there to like getting in on the 4-hour chart.
Mm.
Just barely missed my entry in the market. Clearly has reversed since, but I do own a good collection of like individual stocks. I've bought shares in Tesla, Nvidia, Google, and like all the Mag 7 stuff. I really picked up a lot of shares during the market sell off. So even though I'm not in a Nas trade, I've still got some good stocks and riding the run up. So it's been okay.
Yeah, and plus they were a bit cheap or affordable. I think they were actually it's something that you can hold for quite longer because they've been very high at the moment. Even if maybe not focusing on Nasdaq specifically, but at least you are still participating in these moves. So yeah, that's really good.
Yeah. Yeah, no, and I'm totally with you on that. Like one of the stocks that I really have wanted to build a bigger position in was like Google and another one was Amazon. And finally, Amazon, when I bought it, was down almost 30%. So it went down as far as 33% down from those highs. So you got some pullbacks on some really great companies. And like you said, I am, most of these positions are long-term plays for me. I'm not looking to like sell them next week or anything. These are longer term buys that I've waited for a long time to finally get in. Another one that I really like is Fortinet, which is a cybersecurity name, which I think is pretty recession resilient, because cybersecurity is something that companies, governments, and individuals will continue to need to spend money on to protect themselves from all this AI stuff, and hackers and all that stuff is kind of a forever spend for companies. It's like if a big company gets hacked, it can ruin their company, right? So it's really important that companies continue to spend money. So I do like trying to find names that have, even in down times and bad times, they would still be attractive companies. So when I buy stocks, I try and buy stuff would relatively be resilient. Not every name I own is recession resilient, but I do try and keep the majority of my funds into things that are a little bit more recession resilient, if you will. But then I also have NVIDIA, which is definitely not recession resilient.
Yes, I think Nvidia is still gonna have these crazy moves, especially when everyone is like watching what's really happening. So on that, I think it's still a good company to hold, but I think Meta platforms and Google, they're still going to offer quite similar things. So holding them, I think they're not going to go aggressive, or the volatility is not really going to be the same, but they're still pursuing the same thing, even though the difference is the chip. But beside that, they are quite similar companies. And I think going further, they are going to develop their own chips going further. But at the moment, they're still relying on NVIDIA. So I think they are still stable. If maybe China and US do something with the tariffs, they're not suffering the same way as NVIDIA. So I think they will actually perform very well in the long run.
Yeah, no, I like both companies quite a bit. Meta, Google, both, the biggest advertisers out there, and Amazon also big advertisers. So really good opportunity in the last couple months to pick up shares and stocks. And again, what's kind of a tough thing about it, Kenzo, is that when this is happening, most people are just so fully convinced that they should sell their stocks, right? People, unfortunately, the news does a great job at like scaring people into selling their stocks at this time and buying stocks when they're high. It's amazing how that works.
Yeah, that's the thing, because companies, they were meant to grow, like it or not. They might not perform very well now, but they won't sell like 2 years straight. So one way or another, they will actually recover. Unfortunately, the news, they will sell you breaking news every day. And without breaking news, obviously, you can recommend them. So it's attention-seeking strategy. When they say breaking news, 1, 2, 3, this is selling, this is buying, whatever, mostly people start to panic, and they will keep selling or do something. But that is, if you check it from a distance, it's a good opportunity for buying zones or cheaper stocks.
Yeah, I agree. And that's again, over the long term, those companies I think will do great. And the other thing too is if you buy a collection of companies, some of them might not do great. Some of them might go to zero over the next 10, 15 years or whatever. But most of them, if they're really good companies growing and developing further and further, will likely do very well. And the overall return should be pretty good if you have done your homework, research, and found good companies to hold for the long term. So yeah, for me, stocks and options play a key part of what I do. And then also I obviously have the trade side, right? So for trades, I am looking for index buys if we can get them. NFP today was a pretty good report, and we'll see where those go next. Kenzo, I thank you for coming on today. I appreciate your time as always. And for everybody who enjoyed that commentary from Kenzo, let's just do a real quick thank you to him by subscribing to his channel if you have not already. We'll drop the link here in the chat to where you can find out more from Kenzo. It's Extra Hot Forex on YouTube. If you're watching on a television or another device where you can't easily click a link, just search up on YouTube Extra Hot Forex. That's Extra Hot Forex. You can find Kenzo there. Kenzo, thank you very much for coming on the show today, man. Good speaking with you.
Thank you very much, man, and also your viewers.
All right. Have a nice weekend. And up next, we do have, of course, Forex James joining the action here. A stream regular. We'll hear from him in response to this NFP report, which came in pretty solid, but dollar index is still kind of down. So again, we had an up day for the dollar, kind of just giving back those gains and flat in the last few days on the dollar. So we'll hear from Forex James in just a second. Before we break to that, just a reminder, Edgefinder sales coming to a close. You can currently get 45% off the Edgefinder. It's a one-time payment, and it's the biggest discount we do all year long. Don't miss it. Coming up next, we got Forex James after the break. If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
Hey, happy Friday. It's good to be here. I hope you're all well. Hope you all had a good week as well. So, US data, not very impressive, to be quite honest with you. It's really not interesting. NFP was okay, 177, definitely beat forecast. Previous was revised down to 185K. So if we're comparing the actual to the previous, yeah, not great. The unemployment rate stayed the same at 4.2, which again isn't great. Average hourly earnings took a hit at 0.2 from 0.3, or sorry, the expected of 0.3 and the previous of 0.3. So again, yeah, not very impressive. But the dollar did rally off the initial reaction and very quickly heading back to the downside, which really isn't a surprise, to be quite honest with you. I mean, the data wasn't anything special. The US dollar, however, faces the really, really strong monthly level right here. So it's, still in my case, or sorry, in my view, it's still a big thing to just watch and see what happens here, because it looks like the dollar bulls tried to step in and they've not really had much success. But the really key thing is if we can close this monthly candle below the sort of 99, 100 psychological levels, that would be a big thing, because that means that the bulls can't hold on. 100 isn't a light thing. That's a big level to just break through. And if the bulls can't hold on to that, then we're likely going to go and head down towards 95, 90, I would say. Bashi, ball out. Hello, Tiger, Panda Forex, Shells, Lee, good to see you all. So yeah, no change for me in terms of what's going on with the dollar. I'm still just waiting to see what happens with tariffs. Gold, I am considering actually a short. I'm not going to take this just yet because the trend is still to the upside. This is still a higher low in my view compared to, or relative to, the previous low. But so far, the technical setup looks really strong. And I just don't have a justification to buy gold. I really don't see a reason to right now. We spoke about it yesterday, but if we look at what's going on, we've had a huge problem with trade fears. So obviously we saw investors going into gold. Then we've had the 90-day pause. Europe has, as last thing I heard, this might have changed, but last thing I heard, I think it was yesterday, Europe has already got a plan written up for the US for a trade deal. Seems like China is also on the table there as well, potentially. So there is that sort of fading out of the mix. So gold short's potential, like I said, I'm not going to take it yet. I'm just going to wait and see. But the idea is there. So it's something in the back pocket if I see it start to come into relevance. Gold, two scenarios: either break of the high, or goes up to 3,400 and then one more drop down to the end of the year with a break over high seasonality. Fair enough. if that's what you see. Yeah, oil, I don't, really don't see anything on oil at all, to be honest with you. I wouldn't want to buy oil. It's too low to sell, so I'm kind of just flat here. Absolutely nothing to do there. Let's see. As I said yesterday, I'm not really looking for anything new. We did take a look at pound yen this morning on my stream. The technical setup looks fine, and I don't mind the idea behind it. So again, as we were saying on yesterday's stream, the yen, the markets have seen, oops, that's not what I want. This is what I want. The markets have seen a change in sentiment. We've gone from pretty risk-off, quite strong risk-off sentiment to now being a little bit more risk-on, cautiously optimistic is how it's categorized at the moment, which in my view is going to lead to an outflow of yen, Swiss, and possibly an inflow into the dollar, but we'll see. So obviously we've got the pound, which is risk-on, we've got the yen risk-off. So if we're seeing that change in sentiment, we possibly could see yen continue to sell off. We could see buyers coming into the pound. We've got the short-term trend change here with the moving averages, and we have also got the fib level here. So I'm just going to wait and see what happens. I'll probably wait until Monday. I'm not looking to take a trade on Friday. I don't think there's really much of a reason to. The only real problem I see with pound yen is that the central banks are just too divergent or too diverged. I'm not really sure what the right word is there. But we've got the Bank of Japan that is still on a path to normalization. Although their statement was quite dovish previously, the long-term outlook is still hikes. The Bank of England is expected to cut on the next meeting. I think it's in 6 days is the next Bank of England. So we'll see. But there is obviously, we've got BOJ hiking and the Bank of England cutting. So not the best environment to buy pound yen, but if we see the opportunity, then I'll try and capitalize on it. Gold short make more sense. Oh, gold shorts make more sense now, but how many days since the 90 days? I've got it written down. Actually, let me just double check when that 90-day thing was announced. It was on March 9th, I think, if I've got that correct. So yeah, it'll be, I think, towards June when we get the when that 90-day pause is done. Too low to sell oil is a good reason to buy. No, it's a pathetic reason to buy, to be honest with you. I know it sounds a little bit harsh, but no. Just because something's low, it doesn't mean you should buy it. You should have a reason to buy it. Unless it's something like the S&P or a very, very high quality stock like, Nvidia or Google or Amazon, maybe so. But oil, no, not in my view. Oil could go a lot lower. If you want a little bit of a horror story, something to really show you, let me show you this. Hold on. Where was it? Yeah, here. Gold went all the way down to oil went all the way down to $7 a barrel. It's also been in negative territory before as well. So yeah, just because it's low, it could go much lower, is the moral of the story there. Are you still long? Yes, the long is still open, Babu. Yeah, it is a bank holiday on Monday. That is truly. So yeah, probably the pound yen idea might have to wait until Tuesday, but we'll see. It's fine. Like I said, I've got no rush. I'm quite happy with the positions I've got open, so completely fine. Yeah, off the main, that's exactly the point. Just zoom out. If you think something is too low and it can't go lower, just zoom out and you will see. UK 100 is looking great. Yes, UK 100 actually, I've completely sort of overlooked it, but it is something that's been stored in my little brain for a while. I've been talking about it for maybe the past 2 weeks or so. But yeah, I've just not done anything because I can't take, I'll explain why, but I just can't find an entry at the moment. The Dow, the NAS, the UK 100, are all really, really good opportunities to get into them. In terms of the economic indicators, but the technicals are just disgusting. Like they're just really, really not good right now. And that's just from my personal strategy. Huge run up here, very little give back. Obviously, I know this is a correction of this left side move. We've now also just filled this gap. We've got almost what looks like we're about to have this trend change, which is a good sign to buy. So yeah, I think actually the FTSE probably the only one on a technical basis that might be okay. But if we go ahead and have a look at things like the S&P, we've still got this gap. Same thing on the Dow, we've got the gap. The NAS, we've still got this gap here. So I think I'd also love to get in the NAS, but the only way I would buy the NAS is if we came down, filled this gap, and had a 50% retracement. But it doesn't look like that's going to happen, at least yet. So what were we actually talking about? Yeah, the FTSE. So yeah, the idea behind the FTSE is very strong. Oops, that's not what I meant to do. Yeah, there we go. Yeah, the theory behind the FTSE long is completely fine in my view. I'm not sure I'd want to hold it into new all-time highs, so I'd probably start looking to cut the position at these previous highs. And the reason is, you could argue, you know, it's an index, why wouldn't you hold it to new all-time highs? And it's because I hate the FTSE. The FTSE is a disgusting, horrible, ugly, useless market. And when I say useless, I don't mean it's obviously not useless, but it's just a horrible market. I mean, look at the price action. It's just range bound, up and down, choppy, nonsense, mess, horrible stuff. So yeah, there's no chance I'd be looking to hold that for too long. I just take into next high, take into previous highs, and just let it go. Oh, sorry, take profits, not let it go. Oil went that low. Yeah, MP, that's right. But there is also a previous time when oil went into negative territory. So yeah. That news indicates strong or weak dollar. To me personally, it doesn't indicate anything. It was pretty neutral. We had a little bit of an overshoot on NFP, but hourly earnings came down, unemployment stayed the same. So yeah, it doesn't really sway me to buy the dollar or necessarily sell it. No, MP, I'm not saying oil's going down to $7. I'm just, the reason I said that was because someone said, if it's low, shouldn't you buy it? I was just trying to visualize the idea that because you think it's low, it doesn't mean it can't go lower. Bezos, explain to me what the news was that was positive for the dollar. If you're looking at just NFP, then yeah, fine. But then what about unemployment that stayed at 4.2? What about hourly earnings that ticked down? You can't just look at NFP and isolate that and say it was good news for the dollar, because, you know, if the markets are disagreeing with you, which they are, then, you know, it doesn't really work out, does it? As Omar said as well, though, we are not really in a great place for the dollar. Regardless of today's news, the dollar is just not really that attractive at the moment. I am tempted to start or to try a long position, but I just can't do it. If I was a bigger risk taker, I was a bit more speculative, I would probably do it, but yeah, I can't do it. Cool. Another hot day in the UK. Cannot wait to get away from the desk and just go outside for a bit. That's a trap I usually fall into, only watching the latest report got taken into consideration. Yeah, well, if you've got the Edge Finder, it's all done for you. Use code ELITE, please. Does help me out. That's not what we want. We want here, labor market. So yeah, we look. So yes, 177K was okay, beat expectations, but it's still pretty naff. I mean, this was revised down to 185, but it's still worse than the previous. So yeah, again, it's not awful. I'm not saying the NFP release was terrible news, but it wasn't great, I would say. Definitely wasn't something I'd be heavily buying the dollar for, at least. Can we see euro dollar? Of course you can see euro dollar. You can see my losing position. Oh, actually, it's coming back a little bit. Just avoided stops. So yeah, we'll see if this one can actually prevail into something. I'll go over euro dollar in a second. I'm just reading the chat. Hold on. You love Edge Finder. It's been a godsend. I've got to say that the Edge Finder is it's a very, very useful tool to have. And I'm not just saying that, by the way. If anyone, actually, this is a bit of a story. For anyone that does think I'm coming on here to shill the Edge Finder and just to promote it or whatever, I'm not, because I actually bought the Edge Finder before I was on the stream. I bought it back in, I think it was like 2021, 2022, around that time. And I don't think I was actually, talking to Nick or involved in the A1 show at all back then. So there you go. I bought it because I genuinely like it. Anyway, let's get back to the point. Euro dollar. Where was I? I had a fib here, but I can't remember where exactly I drew it from. I think it was here back when I entered it was. Okay, let me just put replay mode back on so I can show you why. Yeah. So the theory, the reason I bought euro dollar here is because, yes, I think euro dollar is overvalued. I've been saying that. I've been very vocal that I don't think euro dollar should be worth what it is right now, but it is. And what can I do about that? Nothing. I can just trade what it is. So although I don't agree with it, I can't do anything about it. So I'll trade. So fib from low to high of this range. Obviously, we've got this 50% 618 golden zone on the fib. We had this H4 bullish candle close. So I was like, you know what? It looks okay. I'll take it. The dollar at the time was dropping, and it still is dropping, so it seems fine from a currency strength aspect. And if we look at the behavior that euro dollar displayed previously during this period, we had the range like we had here, then the pop to the upside. So I was looking for a very similar play with the range and the pop to the upside. Now, have we had that? Not really. We've actually kind of just stayed within this range, but we might still have it. So we'll see. But yeah, I am very mixed on euro dollar. I don't think there's enough to support the euro right now to warrant this type of trend. It's mainly driven by outflow of the dollar, inflow into the euro, because the euro is the next liquid asset from the dollar. So it makes sense that if investors are not wanting to hold dollar, but they're still wanting risk on, they will go to the euro. That's quite simple. So there is that. So that's why I'm long euro dollar. Hold on, you guys are quick today. Let me just take a second and read. I'm a slow reader, so bear with me, please. Royal Trades, good to see you. What for silver? I don't have any theory on silver. I've got no thing there. I would lean towards a possible short, but I don't have. Again, I've got no fundamental thesis or anything really to buy or sell silver. From a technical view, as I said, shorts look a little bit more interesting, just because we're sort of rejecting this level here. Moving averages acting as dynamic resistance. In this case, we've got some traffic here on the left that could be corrected. But that's pretty much it. That's all I've got. I do think that silver has a lot of room to the upside in the longer term. But obviously, if we're talking about short-term trade, then yeah, shorts. But long-term, I'd be quite happy to actually buy silver up into about $40. But to do that, I would need price to drop to sort of 25, 30. Can you please tell me what happened on the 15th of January? You know what I can tell you? Google. No. Well, yes, but what happened was the SNB chain. You know what? I actually can't remember the exact story. The SNB or Swiss National Bank, they reduced something. I think they just intervened, but it was in a pretty serious way. Let me just Google. Let me just refresh my memory. I'm saying you should use Google. I'm using Google. Here you go. That's what it is. So January 2015, Swiss National Bank made a significant decision to discontinue the minimum exchange rate. That was it, yeah. Minimum exchange rate for the Swiss franc against the euro. So there you go. Obviously, feel free to go and research that. I'm not going to sit here and do all that. Gonna take a stab at GJ 191.5. Good stuff off the main. Hope it goes well for you. Sweet. Yeah. Oh wait. Oh yeah. No. OT. Don't go down to the 1 minute. Terrible idea. Majority of it is pretty much just noise, in my view, anyway. So I'm just seeing. Unfortunately, I missed the dollar Swiss trade. I was considering this 50% sell, or sorry, to sell on this 50% level. But yeah, I just couldn't pull the trigger, especially with the dollar where it is. I mean, we spoke about this slightly earlier. I just don't want to get involved with the dollar right here. It's just such a pivotal level. If it's rejecting, I think it will reject quite hard. If it breaks below, I think it will break quite heavily. So I just don't want to be on the wrong side of that, really. I'd like to just wait to see what happens. Then I'll jump in. Yearly time frame. Yeah, good luck. Your trade might hit take profit by the time you're 90. And you'll need about, for a stop loss on the yearly, yeah, you need like 20K minimum. Wait, Tiger, what are you saying? Oh, yeah, kind of. I read that message. I was like, what do you mean by a pegging? I don't want pegging. Sorry, that's not PG. I'll take that back. Today's positive NFP should have allowed the dollar more gains, but it still dropped despite positive ease in tariffs. Could you please explain that? Bezos, I've explained it like 2 or 3 times now, my friend. You're isolating NFP. You're looking at it through a microscope and saying NFP was good. Why is the dollar down? It's not that simple. We had average hourly earnings down. We've still got the trade tensions on the table. We've also got unemployment that stayed at 4.2. So there's just, why would the dollar rally off the back of one good NFP print? Bearing in mind, NFP, yes, it beat the forecast, but it was still lower than previous. And previous was revised lower. So there's just not really any reason for the dollar to have really benefited much from that. And that's my view on it as well, that, you know, someone else might see it differently, but yeah, I just don't see it. It's nice to have a live stream full of economists and degenerates. You know what? Croaxa, I'm not sure I'd say your name. I'll say that. You've caught me on the good day. I'd say like 55% of the time I'm a bit of a degenerate, to be quite honest with you. I think Wednesday was a particularly bad day. I was a bit loopy on that day. But no, this stream is good though, in seriousness. I think you'll find the majority of serious traders in the stream because they're actually trying to either learn or they're trying to contribute, which is the best environment to be in. Yeah, Tiger, that's the thing. I think there's just no reason for the dollar to really be strong at the moment. And again, I just want to clarify, it's the way I see things. It is slightly up to interpretation to a certain extent. Okay, right. I'll be honest, I'm hot and I've got nothing on the watch list that I'm actually thinking about taking. So please throw me some questions, because otherwise we're going to have the rest, we are half an hour of me just sat here rambling about whatever comes to my head. Well, 1 minute traders could survive torture. Yeah, they definitely are. Well, actually, I think swing traders would do okay as well. They got the patience to deal with it. And that pain of sitting through a trade for 2-3 weeks and then it just hitting stop loss or break even. It's painful. Dennis, you're trying to learn. You're in one of the best places you could be to learn. This is like a free mentorship class every day, in a sense, because you've got traders from different parts of the world with different styles, different strategies, different thought processes, and you can ask any of them questions pretty much any time, and you're more than likely going to get a pretty solid answer from them. Am I still in Euro New Zealand? Royal Trades, no, unfortunately not. I've stopped at break even. I still really like the trade. I'm probably going to jump back in next week. But yeah, unfortunately, when the euro had its little bit of a meltdown the other day, we were taken out. When I say meltdown, I don't mean it literally. I just mean, you know, when it had that little sell-off here, it took me out at break even because we had, or I had, the position I had was here, roughly, give or take, somewhere around there. So we had a position like this. We got up right to here. I said, you know what, stops to break even. And then we got stuck at break even. You know what, though? I was stuck with the, you know, the screenshot curse is what they call it. When I took a screenshot and I was like, this trade's doing so well. And then a few hours later, it's done. What do you think about Indian stocks? You know what? I've got absolutely no input in Indian stocks or India at all. But I really think India and China are really, really good to potentially get into for the future. And I don't have any data to back that up. It's just a bit of a feeling I've got. So maybe I'll come back with something in the future and then try and pitch you guys into why you should invest into India and China. But yeah, you can give me all your money. GU, Mark Hill. Is that right? Oh, sorry. No, not Mark Hill. Mark, you chill. No, you chill. I suppose it would be similar to Euro dollar in terms of it just being a long position, really, because I'd love to go short. I think, you know, if there was a reason to go short, I would be, but I can't find one at the moment. So to be honest, I think I'd be looking to go long, something along these lines here. Let me just consult the Edge Finder and just see if there is GU on there. Give me a second. It is bullish. It's got a score of 8, which is quite convincing to me, actually. I like an 8. It's a pretty solid number. So I wouldn't enter now. I mean, we've just had US news. It's Friday. Just chill. But maybe next week. Obviously, we've got the bank holiday on Monday for the UK, so also probably not Monday. But maybe Tuesday, Wednesday, we could maybe get a long position in. I won't because I've got Euro dollar open, but pound dollar I think is also a good choice. Is AC not common? No, we don't really have AC over here. We have it in office blocks or office buildings and shops, but in houses, not really, no. We don't have the weather that makes it necessary to invest in AC. Because it's like, it's raining and it's cold, I'd say 75-80% of the time in the UK. So it just doesn't make sense. So I'd rather just buy a fan off Amazon and open a window. Yeah, Sean said the AC is called a window. Hold on, I've just realized I'm really behind on the conversation. Oh, no, I'm not. The screenshot curse was real. Yeah, I think the screenshot curse gets all of us. Oh, James is in the chat. Would melt in Georgia. Yeah, I don't know. I was in Australia last year, and it wasn't even that hot, really. I think it was like 33 Celsius, and that was too much. I was on the beach, and they call it, I can't remember what they call it, but it was like 11 a.m. It's like peak when the sun is at the brightest, the hottest in the sky. I went sunbathing with my girlfriend, and I forgot sunscreen, and oh my God, the sunburn was incredible. I genuinely thought I'd have to go to hospital. It was so bad. I've got a picture of it, and I had a sunburn on my leg where my shorts were for, I kid you not, about a year and a half. It was there. It's only just gone, actually. Anyway, we're getting a bit off topic here. It's funny. I say we're getting off topic all the time, and then we go back off topic straight after. Yeah, MP, I'm the same. Actually, I like being cold. Actually, I'd much rather be cold than hot because I can then just go and put a coat on or a hoodie or put the heating on. Whereas when I'm hot, you can't do anything. You're just stuck being slimy and sweaty and gross. I hate it, especially in the UK because we've got no AC. Royal Trades, I'm not in dollar yen shorts. Similar situation to what was it? Dollar Swiss. So I was looking to take dollar Swiss and dollar yen. They were both in the in the back pocket waiting for a short, but I just didn't really feel comfortable going short dollar yen. I should have done. I mean, I was sat here talking about sells below 150, sell the upside, be looking at a 50% retracement. Did I do it? Nope. Missed the trade, lost out on the money. It's typical. Although I saw you on Twitter, Royal Trades, I saw your position. It's going well for you, so congratulations. In Philippines, 40 Celsius a normal day. That's disgusting. Keep your weather over there. I mean, I'm always complaining about UK weather, but there is also a limit. I don't want 40 degrees. That's too much. Having too much fun interacting with chat. Well, that's what I like to do. What's the point of doing a stream if you're not going to talk to the chat? And it's Friday, as James Tucker says. It's Friday. It's the day off. We've just had news. Markets are slow. You guys are cool. You're my friends. It's like being in a group chat, but I'm in theory talking to myself. So jump into a fridge. I wish I could. You're in that trade thanks to me. You are welcome, Royal. I'll send you my PayPal link after this stream. You can donate some money so I can buy coffee. I appreciate it. Thanks. But we probably should discuss some trading things. So let's just see what retail are doing. I should probably actually give you guys some value rather than yapping. Silver's... Wait, was it silver? I think it was silver. I was looking at it this morning and it's gone back. Oh, it's actually come back a little bit. It's weird. It went straight from extreme greed, extreme fear, and now it's pulling back again. We're stuck in a range-bound put-to-call ratio. What about here? Get rid of metals, commodities, get rid of indices, majors, minors. Dollar Swiss, we've got retail majority long. So shorts are backed up with contrarian trading. What else do we have that's interesting here? A pound New Zealand short. I'm not sure. Pound card, pound Aussie, pound New Zealand. Euro Swiss is interesting. That's getting a sell because we do have a 64% reading of long or retail's long, but I quite like Euro Swiss to the long side. Let's just take a look. So maybe I'd have to jump in with the retail guys. I'm saying that like I'm not retail, but there you go. We can look down on them because we can see what they're doing because we've got Edge Finder, so it's all right. Today you're more happy a beer will do. I've not had a beer today, actually. I've got some arriving today. I pre-ordered some beers for the weekend. I've got some cigars downstairs, so I'm just gonna relax. You're 16. I am also 16. Can you sound to a broker account? No, you can't. I think you've got to be 18 for a broker, especially in the UK. Which moving average? I use the 50 and a 200, Martin. Shantam, I'll be honest, I've got no idea. Apple. Sorry, guys, 1 second. I'm just reading a message. Yeah, Apple is out of my pay grade. It's Yeah, it's above my level. I don't do stocks, unfortunately. Well, Crookster, or however you say your name, I wouldn't worry about it. Normally, the people that don't really fit in at the young age are the ones that actually do quite well. Because, and this is going to sound a little bit, what's that word? Like, you know, those cringe kids that talk about like being wolves and alpha and stuff. I don't mean it like that, but it is probably going to sound a bit like that. I think the weird kids generally do, or the social outcasts, as you said, do normally better because they have such less distractions. Where if you look at people in high schools and stuff, like the popular ones, they going out to parties, going out with friends, they've got buzzing social lives, which is good, that's fine. But it leaves them no time to sit and work on passions and build skills and do stuff and think outside the box. So don't worry. In like the next 10, 15 years, you'll look back and you'll be like, wow, glad I was sat watching Trading Extreme at 16 years old, because now I'm 24 and I'm a millionaire trader. Speaking of which, hey Nick, how you doing?
Hey, I'm coming to relieve you of your duties. James said you're running out of content, and I wanted to step in and say hello, but also I could take over for you if you'd like.
Yeah, no, it's all good. We're just having a chat with the chat. Yeah, it's just the markets to me at the moment. There's just nothing going on. News is done, so it's Friday. I've got nothing on the watch list at the moment. So yeah, quiet.
Totally. Well, if you'd like to bow out, totally cool. If you want to stick around and chat, also cool. Whatever you'd like to do. I think I'm just going to take some questions from the chat real quick. Everybody in the chat, if you'd like to ask a question, James, if you have that, James producer, if you want to drop the link to the question box, if you have that would be awesome. If you do not have it, it can be found on our website, a1trading.com/livestream schedule right here. Click right there and then ask a question for the stream. That's where you can get that link. But just drop your question. Ask a question here. Sorry, go a1trading.com, A1 live stream, ask a question for the stream, and we'll take some questions if you're cool with it.
Yeah, let's do some questions.
All right, I have some. These are fun. I really enjoy doing this, and I like doing them specifically through this form, just because reading the chat can be like, sometimes somebody has a good question, then it gets lost, and I feel bad. So let's see what we got here. So first question, I'm gonna be doing one or two from yesterday. In your opinion, is 1.5% account growth a month good for a swing trader, or is it unrealistic thinking? James, what do you think? In terms of monthly percentage returns, I don't know about you, but whenever I talk about this topic, like, people get all sorts of up in arms. Like, people do not like talking about like monthly returns, because when you say like 2 to 5%, people get like really annoyed. They're like, no, what about like 20%? But what are your thoughts? Monthly returns. Any thoughts there?
I think I'm going to be honest. I think 1.5% is a realistic thing to actually do, but I think to target, I actually would say it's a little bit low. And I'm not saying the return is low or bad. I'm just saying I think you could actually target much more, because 1.5, it's a pretty decent trade once a month. So you could, in theory, you could do maybe a 2 or 3% target a month. And then actually, if you do 1.5%, that's still an amazing thing to do consistently. But I wouldn't say it's unrealistic thinking at all. If that is what you want to target, I would say that's completely fine.
Yeah, and it's even a 1.5% growth, if you plug that into a compound like calculator or whatever, it's amazing what that will do. Like, that's the other thing. A lot of times, I don't think people like appreciate what trading as a skill will do for you. If you like have plans to trade for the next 10, 15, 20, 25, 30 years, the amount, even from a small trading account today, if you actually had the discipline to continuously deposit and compound that account over the years, oh my gosh, like the math is crazy. Like it doesn't sound very exciting, 1.5%. But if you're short-term focused, yeah, it doesn't sound exciting. But if you're long-term focused, it's amazing how much that can do for you. So
Absolutely.
everybody in the chat, if you have a question for James and I, help us out. It's Friday afternoon. We're gonna do a little educational segment here while we wait for Chris. I've been loving doing these questions, and now you get two great minds thinking alike on these questions together. So if you have a question for us, please submit them through the forum. It just makes it easier for us to have these questions in front of us. So you can ask a question by using the link in the chat, or head over to the description, and there's a link in the description to ask questions as well. Let me just refresh.
I think deposits are something that are actually really overlooked, because I'm sure you get it as well, but you talk to a lot of traders on a daily basis, and they generally will say, I've got, maybe $1,000 or $5,000 or whatever it may be. But yeah, if you think about how much money you will generate, and just from income or gifts or whatever it may be, from family members, friends, whatever, over the years of 5-10 years, it's a lot of money. And if you deposit it and compound that, it's amazing what you can do. But when you have $1,000, you're not really thinking about it. You're like, oh, I want more money, I need more money, I need it now. And I think it's a big downfall, actually, because that is normally how people end up blowing accounts and just losing money because they're so desperate to do it now.
What you just pointed out is like one of the biggest secrets of trading. It's the most unattractive truth that is so powerful for trading, and it is depositing, not withdrawing. When you first get into trading, what do you hear? Oh, I'm going to cash out this week. I made $5,000. I'm going to withdraw and go spend it up and have a great time. And then what you realize like years later is the best thing you could possibly be doing and the worst thing at the same time is like your inputs and outputs. If you're adding to your account, you're scaling up. If you're withdrawing from your account, you're stunting the growth of your account. That is the truth. So really, you should probably, if you really, really intend on scaling up your trading over the years, you should really find other ways to like fund your lifestyle, keep it minimal. I know, James, you're huge on this. Like I loved your video that you did on this. Like keep your lifestyle minimal, and then fund your account as much as you can, as early as you can in your journey. And it's going to roll up and up and up. And eventually, yeah, you can go do whatever you want with that. But that earlier, the more money you have in your trading account that you're compounding at younger age, it's time. Time is a way more input variable than how much money you have and how much, percentage you can make per month. At the end of the day, here's the thing, right? I don't have the math in front of me, but I would make the guess that if you have one trader who's making 5% per month, but never depositing, and you compared that with someone who's making 2% per month, but depositing aggressively every month, that 2% person is going to make way more money. Even though they're not making 5% per month, they're making 2%. Like, so people get so stuck on percentage returns when you've introduced properly, probably the most important variable, which is deposit rate.
Yeah. I have last thing I'll say on that, and I think it's a little bit, some people might get it, some people think I'm a bit crazy, but I really think when you start taking finances in general, not just trading, but it also applies to trading, when you take it seriously, you will eventually come to a point where it's almost like money is coming to you. And it sounds really strange. And if you've never felt that before, you probably don't get it at all. But Nick, you might have felt it when you had, maybe A1 had a great month, or you had a great month trading, and you started seeing money a little bit differently, or you might have started saving money, or, treating it as it should be. It starts sort of just, coming. I can't explain it, but it's almost like manifestation. And I'm not a huge believer in that type of thing, but I don't know. It kind of happened to me, and it was very weird.
Well, and another great way of putting that too is like a lot of people trade like they need that money tomorrow, and that will mess you up so bad. Like if you're trading like I need this for rent money. That's why they say don't trade with money you can't afford to lose, because inevitably you're going to have losing streaks and drawdowns. And if you're not too pressed about that, you can stomach those things, get through them, move on, and get back to all-time highs in your account. But if you are not like able to stomach that because you're so petrified of losing money, it's almost like the more afraid you are to lose money, the worse your trading gets. Like you have to be able to accept the risk that's being done and kind of be like, okay, I'm sticking to my system and I'm going for it. And I'm not too worried about, intraday drawdowns and things like that. Let's move on to, we got more questions coming in here. So I'm just going to move on. We can keep going with this thought. So let's see. I'm going to skip the chart requests just because I think, we're sticking a little bit more towards trading strategy, psychology, tips and stuff like that. So if you did have a question on that, just tune into the next stream. We'll do more charts and stuff. But hey, Nick and James, in terms of your trading, how do you personally hold yourself accountable and stay disciplined? So for me, really quick, just how do I stay accountable and disciplined? I use YouTube. I straight up, every single day, I think James and I both have this. We come on here and we talk about what we're doing and we share our ups and downs. And there's times like the other day, I closed a trade for a $5,000 loss on gold. Like that's accountability. I had to take that trade. I shared it publicly, start to finish. I also have winners that start to finish. So I use social media as a bit of a journal for me. But if I wasn't using that, I would probably still grab like a trading friend or a trading partner, and we'd probably just upload screenshots back and forth of our P&L on trades that we took. I think that's another great way to get a trading partner. What about you, James?
Yeah, same thing. I think this is one way to be able to see if someone is at least worth listening to is anyone can put a picture on Twitter, you can put pictures on Instagram, you can even YouTube videos, but being live pretty much every day, like Nick and I are, you can't really fake that. I mean, we like Nick said, we are showing what we are doing, what we're thinking day after day after day. If everything we did lost money and we weren't actually doing what we were saying we're doing, neither of us would be here. We wouldn't have an audience. Now, the other thing for me is that I have a couple of investors. So if I didn't hold myself accountable, they would in a court of law, and I would rather not do that. So I have to. There's no choice. It's more a case of just, being professional. I sit on live streams and videos, and I normally joke around a lot. Behind the scenes, this is my business. This is my career. I can't afford to behave as I do on live stream with my finances and my clients' money.
Yeah, that's a great point too. I mean, involvement in whether it's investors, whether it be, sharing it with a spouse or something like that too, something to keep yourself accountable is pretty powerful. Royal, trading for 3+ years, asks a personal question: what led you to start trading, in what age, and how did you get to know about trading? For me, it was my dad and my friend Frank. We both, or all three of us, were like into stocks a bit initially. I got into stocks and eventually went to Forex as well, and just kind of never stopped. I just like learning about markets. It went from kind of like, oh, I want to make some money, to very quickly being like, I actually really like learning about this stuff, and I don't really care about as much making money as I do just about learning markets. What about you, James?
I think very similar to a lot of people. Actually, I was sucked in by that Instagram lifestyle. I've got no background in economics or trading or anything. I was working as a graphic designer, motion designer at a TV company in the UK. I was looking, I put money into the S&P, as most people do. I was like, this is just too slow. There's got to be a better way. And then, I found the flexes with the Lamborghinis and the Rolexes, and then joined a dodgy signal group and lost a lot of money. And then I was like, too egotistical to just let that go. So then I started learning how to actually trade properly.
There you go. Okay, next question here from OT says, goal is to become a funded trader. And their question is, what key indicators or patterns do you rely on most when deciding to enter or exit a trade in volatile markets? Good question. For me, it is the most silly, dumb, easy technical analysis ever. I look for break and retests in uptrends or downtrends, and that is pretty much it. I look for higher lows, higher highs, market structure, support and resistance, literally the most retail trading approach you could possibly take, that you could pick off a textbook from any library around you. That is what I use for technical analysis. I don't get any more complex than that. I keep it really, really simple. Most of my harder research comes out of fundamental analysis and understanding the macro, trying to pick out what the Fed might do next. That's where the real meat and potatoes to what I do is. It is certainly not in looking at a technical chart and trying to find a magical edge from that. I find that to be a really difficult way to make a lot of money. And that's where most retail traders spend all their time, and where most institutional traders spend most of their time. I'm not making this up, and I'm not saying this just to fit my narrative. Listen to CNBC, Bloomberg, listen to interviews done with professional money managers, and they are not talking about magical technical patterns that tell them when to buy and sell. The best of the best are talking about what the Fed's doing, what the economy's doing, what businesses are doing, CEOs are doing, consumers doing. That's what this conversation is all about. Retail traders are fixated, focused, and obsessed with technical charts. And it's like they're chasing the shiny object because that's cool and flashy, and literally screens, brokerages and charts all are like kind of designed to be flashy and exciting, kind of like a casino. Meanwhile, what are institutionals doing? Again, economic data. So don't get lost in the sauce and technical analysis. That's my personal opinion.
Yeah, I would agree. I think it specifically about the volatile part of that. I think if, for example, if you're trading on the H1 and you see the markets are just dropping and you want to buy, I'd scale out to maybe the daily, the weekly time frame, look for higher levels of support resistance, more places that have a higher chance of price stalling and reversing. Pretty much it. And yeah, fib, and that's simple stuff.
Yeah, it's just again, I think when you hear me say that, OT and anybody else, I'm not saying like if you've spent a lot of time trying to learn technical analysis and improve on it. The thing is, so have I. I went in that chasing your tail concept for years, searching YouTube and forums for what's the magic secret sauce technical indicator or price action signal. And there's a rabbit hole that never ends on that. And I never found some sort of super highly powerful technical signal that told me when to buy and sell. Like I never really found that. The clarity came from understanding why the chart's moving, not trying to use, just because a candlestick forms a certain way, that doesn't tell me with any sort of solid basis where the market's going next over the next couple of days. So, is it useless? No, I'm not one of those people. I don't think technicals are useless. As James pointed out, I just think you would keep things simple. Look at major levels on the daily chart. Keep it as simple as you possibly can. And that's probably all you need. That's, again, at least our take on the matter. Next question from Tiger says, their main goal is to become a funded trader. Question is, I've been trading from the daily and 4-hour supply and demand charts. I like to stay away from the noise. However, since acquiring the Edge Finder, I've noticed I make way fewer trades. It's kept me out of a lot of trades I used to take without fundamentals and sentiment consideration. I'm wondering your thoughts on dropping down to the 2-hour, 1-hour, or even 30-minute time frame for my supply and demand zones. So it sounds like you're wondering if you should drop to a lower time frame in order to find more setups. And I actually think what you said, you may feel like it's a negative, but it might actually have been a really positive thing. Like you saying, I'm taking way less trades now because I'm finding less opportunities because I'm waiting for high conviction stuff. Is that a bad thing? I'd say that's a good thing, right? I would say, you're waiting for these setups now, and your checklist is bigger, right? And you're noticing that you're taking less positions that have higher conviction. I would say that that's perfectly fine. Where in the rule book does it say that profitable traders have to take 4 trades a day? It doesn't, right? Profitable traders, in fact, actually, this is kind of one that you should never tell the scalpers, but statistically, the more someone trades on, results across the medium, the more people trade, the less money they make or lose more money. Whereas like the most on average consistent way to make money for most people, like across the whole group, is to just buy and never touch it. Right. So there are people who are more active that make more money. Don't get me wrong, but the vast majority of people that try and be more active actually end up losing more money. So just something to think about. Anything to add, James?
Yeah, I would say this actually relates. I often say that trading is essentially gambling. Some people disagree, but I don't see much of a difference at the core concepts. And what you've got to think about is the house generally wins. Yes, you can have an edge. You can have certain things that give you a favor. But if you are constantly gambling, you're on that roulette table and you're placing bet after bet after bet, their edge will slowly eat away at you. And it's the same thing with gambling. Same thing with trading. The more trades, the more opportunities you have to lose money. If you're slowing down, you've got maybe 2 or 3 trades a week. That's 2 or 3 trades with a higher probability, a better edge, and like Nick said, you generally just a better idea to have less trades, in my view as well.
Yeah, Tiger, I think you might have answered your own question. Like, I'm taking higher conviction trades. I'm waiting for better setups. Again, I actually know what you're feeling. Like, it feels like when you first get into trading, you're like, man, I should be trading a lot. Like that seems like, to be a good trader, I need to be doing the active placing a lot of trades. When in reality, like, I really think that taking less is more when it comes to trading. Because remember, every time you're taking trades, you're paying the broker, swaps, commissions, all that stuff. Lessen up on the volume of trades and just look for that higher quality stuff with good position sizing, like healthy small position sizing. I think you're setting yourself up for more success. So let me just, this is an interesting concept. I want to create, this is Attila says, their question is, I want to create an insurance company for trading. Why not? 90% of people lose money. Why not use the valuable data and make money on it, especially on the prop trading industry? So Attila, the thing you'd run into real quick in my, this is just immediate. I haven't done a lot of research on this, but my immediate red flag would be, I absolutely would not want to insure most traders. In fact, the only traders worth insuring don't need insurance because they're already good traders with well capitalized. I'm not trying to shoot down your idea, but you'd have to think about this, because your premiums, if you were to insure somebody that has $1,000 account, and they're just going out there and going crazy with it, and you want to insure them up to $1,000, your premiums would have to be over 90%, right? Because 90% of traders lose money. It's probably like 99%, but like that's the low end statistic. Let's say 90%. Your premium on a $1,000 account to insure it would have to be like 90% of that account value, so that you don't get screwed. Because if you're insuring a bunch of people's $1,000 accounts and most of them are going to blow it to zero, right? That's where you'd have to really get into the math side of it. And I'm not telling you that there's not something there, because there may be ways to like basically play the broker. That's what the broker does with margin calls. You're kind of describing like margin calls is where they evaluate your trading and all this and that. So something to think about. I'm not saying that there's nothing there, but you really have to be careful if you're going to insure traders, or think about that. There's probably a whole bunch of like legalities to that, but then also there's a whole bunch of risk to trying to insure. Like, you're almost being a prop firm and a broker at the same time, because you're trying to evaluate people's trading behaviors. Any insurance company is going to evaluate their asset they're insuring. So you'd have to evaluate, you're pretty much talking about becoming a prop firm or a broker.
Yeah, I'm not sure really why or how that would work, to be quite honest. And I'm not meaning to, or like Nick said, I'm not trying to shoot down the idea, but
Yeah,
with things like, let's take car insurance, for example. That's not really based on the skill of the driver. That's just an accident. Anyone can get into an accident, regardless of how good or bad you are. Someone, Nick could get into a car, God forbid, obviously. Nick could, in theory, get into a car accident tomorrow, or I could. It's not a case of a trader's profitable or not profitable. It's a very different concept in my view.
yeah.
So yeah, I'm not sure about that idea.
Well, and if you're looking at like a car or a house, there's like some amount of value that whereas with your insuring someone's trading account, the expected value of that is for it to lose value substantially, like quickly, like $1,000 likely going to zero for most traders, unfortunately. So it's just the reality of it. It's like trying to insure somebody whose crash rate in their car is 90% of the time they get into a crash. So it's really a challenging. It's an interesting concept, and there might be some way. It may not be like, oh, I'm going to protect the whole amount of your account, but maybe you like talk about like doing some partial rebates, or maybe you do the other way around, which is what the prop firms do, where they say if you do really well and you're the exception, we'll find ways to compensate you, but they're really getting paid out by the 90% of people who are losing money. So prop firms have done it the right way, I think, by doing the opposite. They've bet against the average trader, which, call it predatory, call it just a business, I don't know, but that's something to think about too. Prop firms are making a ton of money by doing the exact opposite. They're not insuring you. They're basically collecting a premium from you. They're selling the insurance to you rather than, the other way around. Anyways, James, we got to go. We got Chris Pulver up next, and we've kept him waiting. So thanks for doing the questions. That was fun, just doing a couple with you, and maybe we can do more of that in the future. I enjoyed that.
Yeah, no, I enjoyed this. It was good. Do you mind if I upload this onto my channel just before we go?
Go for it.
This little segment. Cool.
I think it's
all right.
segment.
Well, guys, have a good one. I appreciate you all being here. Enjoy your weekends. I'll speak to you all very soon. Thanks, Nick.
Sounds good. And just a quick plug for James also. His channel is Forex James. You can find him on YouTube if you want to find him there and maybe see that clip later today. All right, up next, we got Chris Pulver. See you, James.
Hey everybody, thanks for tuning into today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show.
What's happening, everybody? Happy Friday. What's happening? What's new? Well, markets are up again today, kind of. We came up and filled this gap. This is the gap from April 2nd. I had this drawn on the charts this week. There was certainly a head fake with the GDP numbers on Wednesday when the market dumped about 2.2% and decided, that was just a little spot to buy the dip. So we came back up and filled this gap. We do have a gap down here. We do have a gap as well in here. But hey, look, if the market's going to keep humming along until this structure breaks, maybe a bit more aggressive on a trend line, I'd say we just let the melt up continue, shall we? If it's going to melt up. A couple things I want to bring your attention to. I would say I don't get super excited about where we are at. I do have a big question mark. I pulled this yesterday from Bloomberg, which I thought was interesting. Widest gap in sell side S&P 500 targets this century, which means from the year 2000 to now, nobody knows where the market's going to go, right? The gap between the highest and lowest year-end price targets. So forecasts, some say 7,000 plus, some say we're going to be down. Doesn't matter. Point is, it's the widest in history since, I guess the widest of the century. So for 24 years, where you could argue like 1990 to now is like the modern market. The left tail, right tail, the distribution is so wide right now. So what does this really mean? Nobody knows. Nobody knows where the market's going to go this year. I don't either. And it's okay to say that. For anybody that claims to know where the thing is going, they're full of crap. Like, look, I'd say the easiest way to make money this year is if we're pleasantly surprised to the upside, there's ways to make money, right? Like that's easy money. Okay. I have been grinding all year, money on hedges and protecting, having the courage to sell premium during a nasty downturn when the VIX was spiking up to 45, 55, and 60 when it peaked, and then riding some of those out for those 30 to 45 day windows, which a lot of these trades have been closed up for profit. I think last week I closed up over 130 trades for profit. This week's been pretty active as well. I did some rolls. I did some pruning. I did take some profit. I closed another one out for Oracle. See if that was this page. Yep. So Oracle was another winner. That was a ratio spread that came back up. It was $1.31. Closed it for 91, just taking the winner because it was coming back to my assignment price. HIMS has actually been a trade that took off a little bit. So give me my price. What are you guys doing here? HIMS is at 38.96. I don't want to get super greedy here, but I think that HIMS, let me see if I can grab a profit chunk here. I might go. Gonna leave a small credit out for the SPX trade. HIMS and HERS. So there's earnings on May 5th. My expiration's out to May 16th. I actually did a diagonal spread. So here's what the trade looks like. I did a ratio spread on HIMS as well as a diagonal spread. Where is it? HIMS. Here's a ratio spread. It's up about 51% of max credit right now. I wouldn't mind owning shares of it. And then I also have some diagonal spreads. So I have a diagonal spread, which is currently up around $500. And it could get called away at 37 by May 16th. This is taking into account earnings. Earnings are the 5th. So this is going to be next week after the bell. So do I have to do anything on this? Not necessarily. What I could be doing is maybe looking to roll this out. I don't want to be super greedy, but there's a chance that if price comes back down below $37 and I don't get it called away, and I guess if I wanted to not worry about this one, I can just take the profit now. So what's the max profit here? This is $22 and is trading for, is that even possible? I don't think they're going to let me close out for more than that. So 37 minus 15 is 22, and it's showing like a 22.80. That's got to be too wide. There's no way they're going to let me close for that. So what did I take this trade for? I'm just going to do some double checking on the debit side. All right, so the diagonal spread break-even price is $32.95. If it gets called away, yeah, about $405 would be my max profit on this one. So let me see here. I don't know if they're going to let me take a trade that is better than this, but I've got a bid price at $22.05. Let me try $22.50. $22.74. Well, shit, that was pretty nice. So 22.74 minus 17.95. Yeah, $490. Yippee skippy. So that was pretty sweet. Well, I guess I'm going to close down some HIMS for some profit. That's before earnings. So I'll take that trade off. Not have to worry about it. So the diagonal spread, which is a 15 and 37. Do some updates here. So this is a ratio spread. There we go. So the 37.15 close. Might as well try to get it really generous. 22.80. 22.80 just got filled. Very nice. Oh, that's a pleasant surprise. 15 by 37. There we go. And this one's a ratio spread because I don't mind owning the shares, but the diagonal spread is closing out for some nice profits. So this will be close. 22.90. 22.85. Filled. All right, just going to do some management on these. Just give me a couple of minutes. All right. 22.85. Very good. This had to be in my diagonal spread peak. There's otherwise I shouldn't be able to close it out for more than $22, but I mean, I'm going to take it. That's for sure. 37.15. Oops. The ratio spread I'll keep open, but the diagonal spread I'm going to close out. Can I get more? Nope. 22. I'll stick to that 22.85. That's still pretty good. Good. Let's give me an extra 85 cents, which I will definitely take. So diagonal spread, close, 22.85, closing down. Okay, 22.89, even a better fill. No complaints. Okay. Closing. Good. All right, so this is a nice little win. So 17.95, closing for 22.85. About 490 bucks on that trade. Still going. Closing. So I'll update this in Pulver. So Pulver alerts, close it. I mean, I'm getting 85 cents more than max. It doesn't bring earnings into play, so I'm limiting a lot of that risk, which I'm totally fine with. That's a ratio spread. That one's okay. I'm just going to hang on to that. This one ratio spread is fine. This one ratio spread is fine. This one's cash account. This one I have both. So there's my call, my call. So my diagonal spread I want to close 22. See if they're going to be generous enough to still give me my 22.85. Yes, I will take it. Okay, and new client account that just came in this week. All right, so closing down some HIMs. Diagonal spread close. Ratio still open. Ratio still open. Diagonal spread close, 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 close. So how many trades was that? That was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 trades. Not bad. 490 bucks. So it was $5,000. 490 times 10 accounts, 4,900 bucks on HIMs. That trade was open not that long. About 30 days. Not too shabby. Yesterday I talked about Tesla. I did roll Tesla out. Couple decisions on that one. Let me double check my butterfly spread for SPX really quickly. How's this not filling? Showing some profit. All right, let's see if we can get up there. I'm gonna leave this here at, I'll go 45. Okay, so let's go to Tesla. I've got to take this trade off really quickly. So HIMs is done. So one part of it, I'm gonna keep the ratio spread on HIMs, but I'm closing out the diagonal spread. There it is. 25 by 20. Closing for 22.85 credit. Close both legs. Net profit would be $4.90 per contract. Very nice. Checking out okay, very good. Tesla. So I made a decision on Tesla. We're trading at 282. I said if it was above $300, I was going to roll it, but here's what I decided to do instead. I don't mind having 100 shares, and I took the income trade out of this May 16th. This is a 111 trade. So I bought the put at 255, sold the 250, sold the 245. I took profit on that. I did a big update in my Pulver alerts yesterday on Tesla. So I have 100 shares. I have taken profit already. I did take this other chunk of shares that I'm currently sitting on. I had a 257.50 covered call for this Friday, which is today, and it's going to get called away. Yesterday, I decided to roll it out to next Friday, which is 5/9 expiration, and I rolled it out for $255 per contract. Okay, so that gives me 100 shares with a break even of 242.05. So I now have, I mean, this is, I'm speaking for all accounts. I have 500 shares in total, but just per account breakdown, I have a break even of 242.05 with a covered call at 257.50. So if it stays above 257.50 by next Friday, I make 1545 times 500. I'm making 77.25 on Tesla. Now, the reason I wanted to consider, okay, do I just keep this one open for income, or do I potentially, run the risk of getting this one assigned? So what I decided to do was close this one for a win. This one I pulled in $3.25 credit, and I closed it down for, let me see what it was. Got it written down here somewhere. Tesla 284 down to 85 cents. So it was a little high there. So 284 credit, and I closed it for $1.85 debit. Okay, so 199 bucks. Now I did that on 5 accounts. So there's $1,000 there with no assignment risk. So income, no assignment risk. Now I'm just going to focus on how aggressive can I keep rolling some calls. I mean, look, if Tesla comes down, it's okay. My break even's 242. I'll keep lowering the cost basis. If Tesla goes up, I'm going to keep rolling calls. I'll roll it week to week to week, and I'll hopefully get like $1, $2, $3 per week. And even if I never catch up with the stock, I'm still just going to roll this thing out and try to increase its bottom line. Every time I roll this, let's say I get $1 for a roll, it adds up to about $500 a week. So it's not bad. But if price comes down and I have to contend with, price is falling and the premiums to go up, which is a good thing, I'm just going to have to make sure that I'm lowering my cost basis. Right. I just saw some news this week, like the auto driving on Tesla is supposedly like 10 times better than any other competitor right now. I think the worst part of Tesla was kind of priced in. I know Musk is now heading back to Tesla, or at least leaving Doge. I think they're still in the looks for somebody to kind of take the helm at Tesla, be CEO. I don't know if he's officially taking a leave of absence or if he's just dedicating his time elsewhere. Nevertheless, markets are up. It's funny how Tesla, I mean, S&P has gained for the last couple of weeks. We're back to the 200 moving average and a little bit higher. Mag 7 did pretty well this week. Tesla was just so beat up. It's like, we'll rip right there. So that's where Tesla was making the big run. I think if we just stay here and chop around, is it possible that we break this high? If we break this high, I mean, the nice thing is it's open space. But just be aware that this could be a range trade. And, could we go lower and then have a pattern on the right-hand side of this? All the above could happen. But if it goes higher, I'm just going to keep rolling, and not to mention a little Biscuit song, but I'm just going to keep rolling covered calls. So this is now a 5/9. Roll to 5/9 for 255 credit, and I will keep just tallying up the income. I'm not going to get super greedy. I would say by the time the Fed's going to cut in June, I'm really curious what the market's going to be doing. My initial thought when I first jumped on today's session was this. Okay, look at this chart. This is the effective funds rate. Okay. The way this times with the market, I am a bit concerned that every time we've seen major cut cycles from the Fed, the markets have never responded very favorably. So if we're looking at this year, 2025, when they start cutting in June, possibly in July, possibly again in October, and maybe by December, there's 3 or 4 cuts that are planned out based on the CME Fed Watch tool. I don't know how this is going to be good for the stock market. I know that everyone thinks like, well, the Fed's going to cut, that should be better. It might not be. Like all the good might be priced in. Okay. This is yet another thing that would make me believe that it's going to be difficult for the market to get to all-time highs or at least have big momentum above the all-time highs. Right. So if you overlay, if I take this chart, let me use a blank workspace here. Let's go blank. And 10-year yields are freaking up. This is another reason the Fed probably doesn't want to cut too aggressively, is because yields are not cooperating. I mean, yields are up 3+%. Basis points wise, they're up about 16 basis points. Anyway, Fed funds rate. Okay, now overlay the SPX. We'll go new pane. Okay, so I'd have to, let me see if I can go to like a monthly chart. There, it should be a little bit easier to see this now. Take a look and see how this has responded to these major Fed cuts. Fed cut cycle, market was down. Fed cut cycle, market was down. Fed cut cycle, market was down. You know, we did cut 100 basis points. Now, I understand that, you know, but we were way up here at like, you know, 4 to 5% cutting down to near zero. 4% cutting down to near zero. 2.5% cutting down to near zero. I know that we're not necessarily going all the way back down to zero. Maybe it's different this time. I just don't know how this going back, you know, 20 plus years has ever been a good sign for the market. So, you know, Trump urging every single day, Fed needs to cut rates. Fed needs to cut rates. Do they? Because history would show that it's probably not the best thing for the stock market. Because usually when the Fed is cutting rates, it's into economic weakness. It's into an economic slowdown. So I don't know. I mean, I have my concerns, but I think if they stay, you know, true to May, they don't do anything next week. This is a 98.7% chance they just do nothing next week. I don't know if there's going to be pressure. All of a sudden, it's like the Fed's, you know, they're too late. They're Mr. Slow or whatever the hell Trump called them. I don't know. It was obviously super good etiquette to basically call the Fed chair a loser. But anyway, I think Powell's done as good as any. Whether you agree with the Fed or not, nobody's going to agree with the Fed. They're always going to be wrong. They're always going to be reactionary. But their job is to provide stability and liquidity, and they do. And, you know, coming into June, right now, there is a chance of a pause, right? This is all kind of shifted, which I think is really interesting. Here's probabilities. So they're looking at now shifting a May to June pause. This changed this week because it was a June, July, September, October, or either October, December cut this year for 4 cuts in 2025. This looks like a pause for May and June. I mean, why? I don't know. But maybe because we have tariff uncertainty hitting July onwards. But I would be buckled up for maybe a wild second half of the year. If the Fed does start to cut, I think that correlation is something we need to be aware of. So just throwing it out there like big picture. Okay. The market doesn't typically respond well to, let me get rid of this one here. The market doesn't typically go well with like aggressive cutting cycles. Usually we don't see that show up and be, you know, super bullish. So anyway, time will tell. But here we are today. Just kind of hanging out. I'm thinking if there's any upside here, just got some real levels. You know, the market makers may be able to defend this level here. Let me see if I can just get out of this butterfly spread. I'm still showing a small profit. So you can get out of here for like 35 cents. fudge. All right, I'm just going to try to get break even then. All right, break even. I'm not taking a loss today. I've had too good of a week. I'm not forcing any trades. Give me 1 second. All right, let's get back to it. So I'm taking a break even on the SPX trade. Let's put this back. Let's go top down. Thanks for letting me, prune the account for a little bit. Close out Oracle for winter. So far for the week, again, active week, active trading per usual. SPX wise, we've pulled back into this 200 moving average. Okay. This is where I mentioned last week, lots of resistance. I don't know what's going to turn the corner here. We've got a measured move towards symmetry. This would be your low to high swing, higher low to higher high. We're almost right there. We've got the March pullback levels. This could be like the perfect little resistance zone for the market to. Look, I'm not saying the market has to go down. Okay, not all the way, but I would say, would anyone be surprised with this recovery? We just have a swing. We match that symmetry, that we pull back into this area, and this kind of big box would be like no man's land. Right in here, it's like the bulls and bears can scramble, fight, claw it all out, and market doesn't really go anywhere. I wouldn't be terribly surprised to see between about 5,500, 5,700. There's just a big range. We don't necessarily justify going higher. We don't really break down and go lower. Economic data so far is okay, despite what we had on Wednesday, which is a big, hiccup in negative GDP print. It's better than what the Atlanta Fed forecasted at like negative 2.5 GDP. It was negative 0.3. But again, you go into like next quarter, do we print another negative GDP? Are we technically in that recession with negative GDP? It's 2 quarters in a row, maybe. Looks like the Fed, which I thought that was interesting, just changed. They pushed their rate cuts back. So instead of cutting in June like expected, now it looks like maybe July is going to be that first cut. That's when the tariff window opens back up, and we're going to see, who lined up and negotiated with the U.S., who didn't. We're going to see what type of creative job owning Trump and co are going to deliver over these next few weeks. But I don't think strong arm the Fed's going to work. So we'll see how it all plays out. But I just think there's a lot of resistance ahead. If you've got profits, it's good to be protecting. It's good to be moving stop losses. Worst case scenarios, you get stopped out for profit. If the market surprises us with more melting up, I don't think this is a broad market. I really don't. Market breadth is still quite low. Here's your stocks above the 50-day. So about 40.55% of stocks are above the 50-day, and then above the 200-day. We're still sitting in a bear market, everybody. Whether you realize it or not, only about 35.58% of stocks are above the 200-day moving average. So that means 65% of stocks are technically in a sell zone. That's not a good thing. So we're not there yet. Like this is not a broad market rally. What has happened is this has been low volume, low market breadth, low participation, probably carried by mags, to be honest. Mags was beat up and probably overdone. So I think you had, strong opportunities to, buy this low and see the timing of like the market low on April 9th, as well as the participation of, beat up mag 7. Tech looked okay. Tech was beat up pretty aggressively. That's a fast rotation. We've seen this come back around 23%. This actually has been better than the S&P. So mags has done better than the S&P in this little recovery. But granted, it was also down a lot worse than the S&P. So you're just getting slightly more beta to that, right? So this was down 33%, while the index was down about 21%. And this clawback in the S&P, about 15%, has been up around about 23% on mags. But again, you can see the resistance. It's right in here. This area between like now at the 200 or this March pullback high, I would say between this area, or even this outer trend line, if any of this sticks to force some resistance, we're probably going to have, if mags drops again, the market's going to go with it. So anyway, something to watch, something to help with timing. If we get another opportunity to, buy based on market breadth being beat up, I'm probably going to take some stabs at those. If we might be at some equal lows, we might be at some fresh lows. But S&P, just trying to get everyone to acknowledge we've got some resistance. That's all it is, right? So we'll see where the indexes kind of top out here. Same thing on NDX, coming back to the March level. This is my measured move. So low to high, higher low to higher high, measured move around 20,300. Qs, do the same thing as a SPY, can measure this all out. I just measured out SPX and NDX, but same idea. Dow's doing a better job. I mean, Dow actually came back this last couple of weeks. We're just pushing up in that 200 moving average. We did officially clear on the Dow. We got back above the April 9th candle. This was like kind of the lagging index here. So we're back above the April 9th candle. Is it able to get up into the 200 moving average? Maybe. Maybe this is just a big chop zone. Okay. And again, think of this from the perspective of where is the market going to put the most pain on traders? The most pain on traders right now would be it keeps going up, keeps going up, keeps going up, keeps going up, makes everyone think that it's like, this is a buy. This is a buy. I think that spot right there could be the ultimate bull trap where the market at least pauses, pulls back. We've got gap fills. We got plenty of levels to go back down and kind of, find some swings. I'm just wondering what the catalyst is going to be. Earnings season, Mag 7 is in. We're going to have some more earnings next week, but it's like the big ones are in. Amazon was decent. Apple was decent. Meta was great. Microsoft was great. Tesla was the exact opposite, but I mean, we still have some earnings season that's sprinkled in, but the big ones are I mean, we saw consistent earnings and solid growth. CapEx spending is still alive and well. I mean, Google, same thing. Like all Mag 7 stocks did pretty well. So do we get up into some bull trap territory? Possibly. How about the IWM trading at 199? I mean, heck, I might get this one called away. IWM, I've got a covered call at 200. IWM here. So I've got 400 shares, all covered at 200. And these are out to June. I mean, I don't really want to roll it out. I want to see how this kind of plays. If I get an extra, $1,200 out of that, that's fine. If it gets called away, it gets called away. But I'm trying to put a lot of my kind of assumptions. Like if I'm going to be bullish, I think the market has runway like through the month of May into probably late June. If the Fed, I mean, maybe there's a reaction in June because the Fed would surprise the market by like, hey, I thought you guys were cutting in June and now they're not. If they pause, I don't know if the market's going to like that or not. If they start cutting in July, is it going to be like with more tariff drama? So I think there's still a lot of uncertainty. I just think that July onward, just be careful. Okay. But catching up a little bit, we'll see if we get a bottoming pattern here in the Russell. VIX is down to some fresh lows as we're just, kind of carving out slightly higher highs. No big deal. The move index for bond volatility. So let's see if bonds have been doing anything. They should be going down. Yep. So TLT is going down, and that's why you have the US 10-year yield going up. And this is one of my big reasons for thinking that the Fed is not going to cut. And if they do cut, this is, and I've had this conversation many times the last couple months with mortgage bankers, and that is, this reaction has never happened. Fed cut rates, markets, bond yields react the exact opposite. So going into this window, if we look at a pause in May, pause in June, rate cuts in July, are we going to see yields higher by the time we roll into that July rate cut decision? Maybe. Do we see yields just going sideways where it's just back and forth? I mean, this is the break. Like the bond market, the basis trade, liquidity broke for about a week. And I don't think it's immediately repaired. So I think in the background, there's probably the Fed working, with the biggest liquidity providers in the world to, kind of settle things down. But I'm a little cautious thinking that just because the Fed's going to cut means it's a good thing for the stock market. I don't think that it is. I don't think that cutting rates is a good thing for the yields either. So things can get a whole lot more interesting with like this soft data, hard data concept. Today's non-farm was okay, but did everyone notice what happened to the revisions? Non-farm was decent, right? 138 forecast. It came in 177. Unemployment rate stayed at 4.2. But these revisions were pretty bad. revision from 228 down to 185, revision from 209 down to 170. So what does that look like next month? Is 177 revised lower, right? I mean, maybe these are all just false number. I don't know. So we'll find out. Cautiously bullish. That's my plan. Okay. All right. Let's go dollar index. Dollar index, is anybody starting to short the dollar already? I would be waiting. Personally, I'd still be waiting for like a 101 or a 102 handle. I'd like to see if this is kind of slowly work its way into some more attractive, kind of perfect technical levels. I don't mind waiting for kind of a perfect trade. If I'm right, I've got defined risk. It's a low risk, high reward type trade because we can get back to symmetry or go lower. If I'm wrong and I don't see confirmation, then I'm not going to force a sell trade. So I wouldn't force a sell trade if I don't see one. Oil, we did come down and stab those lows. We're bouncing off a little bit. I'm going to keep a close eye on this one. I've got that CL trade running to June. UNG starting to make a nice little run. This is a diagonal spread that I'm still working with. This one I don't think I put in a call side yet, but I may. I need to write that one down. So UNG. And I just saw a note here on my broker platform for Baidu. Yeah, it's probably another one to take some good profit on. So the wide bull puts, let's see. Those are fine. That's fine. Covered call, that's fine. We're trading at what? $91. Covered call's May 16th. I'll let that one just marinate. It's the wide bull puts, the 80 by 50 up $250. I might just close these down. Yeah, I think I'm going to close these down. This is up 63%. And it was such a, what's the probability here? June 20th. June 20th for China. June 20th, 80 by 50. I mean, that's a lot of risk to take in there. There's still about a 20% chance that it comes below that. I'm just going to take the profit. I'll take profit over the weekend. I think today's probably relatively calm. So coming to Monday, I'm going to put this on for Monday. A little bit more time decay. Close this out on Monday. Should be the 80 by 50, and it's up around 62.7%. I'm going to see if that'll increase a little bit over the weekend and grab a few more bucks out of it. The other bull put spread, the 5 wide, I'll keep that one. So it's the wide bull put spread. Let me rename this one. So wide bull put spread. This one I'll rename. So wide. Oops, that's not, sorry, that's my bad. Rename would be bull put. So this one's wide. This one's wide. The 5 wide, I'm not that worried about. The 30 wide, I want to, kind of dump a little bit. That one's okay. Covered call. Yep. So this is the one I'm looking to close up. The June 20th, 80 by 50. And then the 85 by 80. And then covered call. All right, I'll organize that. We did dollar. Let's keep going. Gold, 2263. I'd still like to see gold head a little bit lower. Again, thinking about the runway into the tariffs and the uncertainty, if gold just relinquishes a little bit of this crazy run, gold could get heated back up after a pullback into, I mean, we just hit the 21 moving average. It's still pretty aggressive to think like I'm going to buy the 21. I mean, obviously there could be a reaction there, but I think the 21 to 50, 21 here, 21 here. I mean, if this is a ridiculous bull market, then that might be your dip. Adding some more at the 21 period. That's an exponential moving average. I'd personally like to see the 50. I'd say area 1, I'm going to try to be patient here, and then area 2 is going to be at the 144 and the 200. If you're really anxious about gold, then maybe taking a stab at this with a tight stop and see if this responds off that level. That's understandable, but I'm not trading gold that short term. Same thing at gold futures. If we come back down into these levels, I'm looking at probably a 111 trade or 1111 trade on gold. Silver, still haven't broken the highs yet. I also need to come to grips with silver might just be a range trade, that it's not breaking highs or lows. So if silver comes back down, maybe there's some strong support around 29. I still like adding some more exposure there. Really well supported at 26. So I'll just be watching silver. If I can buy some more, add some more exposure, I will. This is still a position that longer term I want to see up into the 40s. Bitcoin breaking some highs. This might be a bit of a melt up into, 100K. We could possibly make a squeeze into the highs. Because this is squeezing a bit inefficiently, I don't think Bitcoin is necessarily going to break to like 120 to 130 without having some type of pullback. This is probably going to be some type of flat pattern, some type of accumulation pattern. So if you are near term Bitcoin, that's a good trade to just get out, right? Like you're coming up here to the highs. That's a good spot. If you were buying, this 75,000 past resistance becoming support, fantastic entry. It's still going up. And right now, you're up 30% on Bitcoin, which is pretty good. We come up to these highs, great. That right there as just a trade, not long-term hodling, just a trade. That low to that high is a great trade on Bitcoin. If you take profit there, I think there's an opportunity to come back down, revisit the lows again, and then start the process over. You trade Bitcoin in 2025. If it breaks and go higher, great. I'm happy with that too. But just in case we have a chance to accumulate, I'm going to look to be accumulating some Bitcoin. So IBIT, same thing. I've got covered calls in the 62 zone. They're not that far out. I think I'm out to May or June on those covered calls. IBIT. So my calls, May 16th, 62s. I'm up about 80% on those. I don't intend for this to get called away. I don't want it to get called away. This is an income trade. I will continue to still sell covered calls. But my 111s and income trades are looking pretty good. Covered calls, naked put combo. I did this. It's already up some profit, but obviously a lot more to go. This 111 looking for profit as well into June. So anyway, I've got plenty of trades. That's a lot of trades running on IBIT. Plus some shares. Work through those. So I'm going to go Baidu, IBIT. Just want to do some organization in the portfolio. All right, MicroStrategy up to 396. They had earnings. Lo and behold, they missed earnings, but nobody cares because MicroStrategy doesn't trade like a tech software company anymore. They trade like Bitcoin. So Bitcoin's up. MicroStrategy pretty much has a moat. Hey, who cares if our business operation sucks? We have Bitcoin. So I think that's really interesting that you can have a failing tech company and a software company and still have your stock perform like one of the greatest performing assets in the last 10, 12 years. Not too bad. Coinbase hanging in there. Got out of these income trades. These are ratio spreads that did pretty well. Ethereum still waiting for the right-hand side of the trend line. Copper, what a mess. Copper is probably going to continue to be messy. There's a high, there's a low. Don't be surprised if we see some wedge trading in here, something like that where it's indecisive. All this crazy head spinning volatility, things just might slow down a little bit, and that's okay. Things might just slow down, and that's another thing traders have to be prepared for. Is it might not be just easy direction. We might hit this rough patch where it's like, okay, direction in February, pull back in March, direction March to April, rip all the way up to April. Did you know, by the way, that April being down double digits at one point? Let's go back to the SPX. Look at the monthly candle. Okay, April. Oh, geez, I got all this crap on my charts. Hang on. Blank. Okay, look at April for the month. So the month started right here. And at one point, the month was down 13.59%. Sorry to everybody that dumped their positions and got scared out of the market, because what did April do? Just fought back like crazy, ended up finishing the month about 1% lower. Just insane volatility. May is, usually a pretty good month for stocks. So I guess if you could survive March and April, you're doing just fine. But it wasn't easy. And I also think that, this is going to be my argument. If we get back to all-time highs, I mean, what an incredibly self-induced, disruptive, like nonsensical bunch of crap that volatility was. Because what it showed is a tough agenda was completely thrown away. Like, we want to come in, we're going to, shrink the government. We're going to, cut $1 trillion in excess spending, corruption, blah, blah, blah. Sounds good on paper. We're going to create a trade war and tariffs. We're going to get the US back on top. We're going to onshore. All of it sounds good in theory. You can't run a government that way, apparently. And I think that's the sad reality is, like, governments are bloated, governments are inefficient, but don't break things, because that has a lot more. I think that has more dire consequences than, haircuts here, trims here. Problem is we just don't have like a bipartisan system really. So anyway, it doesn't matter. I'm saying, like, this is just that's a wild candle. But usually when you see a candle like that, I don't think that is a bullish sign to be like, well, there it is. You just survived that giant low. What I'd say instead is this wick probably means something as far as, like, if the bulls fail, I think this wick is going to get retested in some way, shape, or form. There's still a trend line here. There's some bear trap material, but I mean, pleasant surprise as we go to the upside. And I'm sitting here like, well, that was crazy. I can't believe we went to the upside and hit all-time highs. The other side of this is no man's land, and there's a lot of chop and there's a lot of indecision, and all the head spinning direction becomes quiet, right? All this down, up again just starts to settle down. And that is maybe what we're going to deal with here in the next maybe month or two. If I'm wrong and it goes higher, fine. Portfolio is tilted. I'll benefit from that, but this is still a trader's market, in my opinion. And I'll wait for my opportunities. Okay, so that's where we're at with those measure moves. We did silver, we did Bitcoin. Let's go to, I was on copper here. I think copper is still going to be a lot of noise. So high, low, maybe copper just kind of flakes out with some indecision. There's really good support on copper. It's just going to depend on if the, China, US can play nice together, because that would probably be a good thing for the global economy. Otherwise, copper is probably going to dip back down to the lows. Japanese yen coming back a little bit. Maybe this is just a big range trade. Lows here, highs here. Maybe the Japanese yen comes back down. I'm not sure. Currency pairs have been a little bit messy on the FX side for Japanese yen. Today we have New Zealand and Aussie on top. We got the Swiss was up and then flat. We got the dollar weaker again. Yesterday was dollar strong and Japanese yen weak by a big way. They didn't cut rates or anything. Japanese yen is still 0.5%, right? So this would have been Wednesday to Thursday. Yeah, they still kept rates the same at 0.5, but something they said got the market to hate the Japanese yen for at least the day. All right, let's keep going. Let's see. German markets. Look at this. Jeez, Pete's, man. Talk about a freaking V bottom. And I'll say, just because I'm looking at this chart, it's like, is it possible that the U.S. market does the exact same thing? I mean, the DAX is almost exactly where the whole thing started after just an incredible disruption. Is the U.S. market able to do the same thing? Maybe. Right? I mean, I'm saying it's like, it would be kind of nonsensical because it just seems so disruptive to have that April volatility. But if the DAX can do it, and the FTSE can do it, and all these other like non-US countries can do it, it's like, is the US going to do the same thing? Maybe. So, I mean, what did I do on this big dip? I just sold some puts on FEZ. That's it. Like, it's not a crazy trade. I just sold some puts. FTSE, I'm not trading, but we're doing the same thing here. It's like, we're melting up. We're melting up. We're melting up. Argentina, a little stuck. I'd like to see this one dip a little bit more, but DAX has been good. Like, anybody, buying that 200 moving average, here's the DAX. Anybody buying on the daily chart, that was your dip. This started off like, I was noting early in the year, like, all the non-US plays, like if you're invested in China, if you're in Europe, if you're in Latin America, like all these things were looking better. Well, you had a flush, you had a chance to buy, and there was your dip. So they're still performing well. They're still actually outperforming year to date the US. I just wonder, like, are there legs to this? Is this a broadening pattern that's gonna, end up making some fresh highs but be a bull trap? I don't know. Maybe. If I'm wrong and this thing just goes up here and then consolidates, then maybe this is the time for the non-US plays to outperform. So good for old Germany. China, a little bit higher. Like yesterday was a good day on China. Brazil just hanging out above the 200 moving average. ILF hanging up above the 200 moving average. Mags, just like US markets, we have some resistance ahead. So it could be right at the 200 moving average. It could be the March pullback. It could be this 618 swing. But I'd be watching for some resistance here. If the mag starts to dip or drop and there's follow through, that's probably dragging the markets with it. Apple earnings, I'm watching. I've got see if price can get down below 203. Amazon earnings, we're sitting right in the middle. I should have just fudge, man. It's about a 60% chance to hit the expected move. I'm hoping there's no volatility for next week on this trade. I mean, I could just dump it. Let me see what I'm in for right now. So Amazon. So this trade is for earnings. It's down about 60%. Ugh. I mean, I could take the partial loss and just move on. Apple is a little bit better. But still not profitable. I had a nice win on Microsoft, a nice win on Meta, but Apple, Amazon didn't deliver with a big move. So still get out the next week. Let's see what we get. We're sitting right in the middle, so I don't love this. I don't love that we have to go either down or up. I mean, I think we can get there, but this is my break-even price really going into next week. Netflix still grinding higher. This is why I said don't call the top on Netflix. I'm glad that I didn't because we're just drifting higher. Nvidia, I think there's room to hit the 200 moving average. I think a big tell for Nvidia is if we get a rejection off that 200 moving average, or if we can still climb above it. There's room to get into the 120s, 130 maybe. I've got a covered call and a collar trade in this one just in case. Tesla, I'm going to continue to roll for some income. Berkshire Hathaway just poked the highs. If this was better premium, I would sell this. If this was better premium, I would do like a call condor, which is a, buy a call, sell a call, sell a call, buy a call, create a little profit trap. But if it melts up, that's a silly trade. I don't think the premiums are that great. Let me see. I'll actually price it out real quick. So Berkshire B. Earnings on this one, May 3rd. I'm sure their earnings are okay. I don't want to see that thing surge higher. So yeah, I'm not going to trade this in front of earnings. I'll stand aside, but maybe post earnings I might look at a trade. Anyway, we'll see. Look at this. Bonds, just garbage. 1 to 3 year bonds, trash. Just getting beat up so badly. 7 to 10 year bonds, down. Like bonds are down, yields are up. 3 month, 2 year, ripping higher. Look at that. These bond yields are aggressive, man. Like that is a big, big, big rip. And this is again what I keep talking about this. Like I noted this on the chart, Liberation Day. We have not seen yields go back to that. The Fed cutting rates does not guarantee that the market's going to push these yields lower. Global yields are higher. It's hard to get the U.S. yields to go lower if across the board everything is up. So I think this is that big fiscal cliff, that big liquidity air pocket, that big like refi window that it's going to be tough. If everyone that took 5-year loans at near 0% during COVID, nobody's going to want to finance at 5, 6, 7, 8%. That makes things very like that is the poster child for this economic slowdown. I mean, on a positive note, we don't have like crazy high inflation right now, but yields are sticky, and we're not we're not sub 2% inflation anyway, but yields are still sticky and going up. So bonds had a rough day today. Currency wise, let me see some China here. So Alibaba, Baidu, I'm going to let this one sit over the weekend. FXI, KWeb, JD. I still have JD looking to get this one called away. At 40, I could probably roll this one down. Let me check real quick. So I have the shares covered at 40. Naked put combo. Maybe not a bad trade either to close out. So some JD. That's further out than I'd like to be. So 27.25. I mean, I sold 3 puts, collected $5. They're up $300 right now. That wouldn't be a bad trade. I still have a covered call on some of the ownership. The 27.5 and 3, so 27.5 and 3. And then the 40 is a covered call. There we go. So wouldn't mind grabbing some income there. That'd be another $900 on JD. But I'd like to see if this can hold. If we hold these lows, I mean, maybe it's a range trade. I just don't want to see it breaking down below here and have those puts exposed. So I'm probably going to take those profits. All right, SEHD. This is dividends. This is growth. You know, clawing back in a good way. These aren't super volatile. I mean, it was earlier. I'm down a little bit, but if we come back to the lows again, honestly, if you want a cheap ETF way to expose yourself to some growth stocks, there's about 200 in this ETF here for growth stocks. Schwab dividends. This is similar to the Dow, but it's just way cheaper. Would you rather buy the QQQ? Would you rather buy the QQQ at 488 to have your top 100 tech stocks, or would you rather trade SCHG, which is about 200 growth stocks, and it's a $26 ETF? So I'm saying this like I don't want to buy it necessarily at $26, but $26 down to $21, I'm okay dollar cost averaging there, and that's a very cheap way to kind of trade the Nasdaq. I don't get the same type of option trading like I would in QQQ, but even if I said, okay, I like this area, I'm already long, by the way. We came to the 200, I'm already buying this. So I already have some shares right around current price. What I'm saying is if we come back and revisit the lows, I'm going to buy some more, right? If we have a high, low, lower, high, lower, low, lower, I mean, that's fine. I'll scoop up some more. I'll wait for maybe 20 to 30. 50% might be like the generational opportunity, like back the truck up. I'm at 54% cash. I'm going to deploy most of that. If we're at 50% down on a lot of these indexes, if we get there, then yeah, I'm going to buy the crap out of this stuff. But this is a really cheap way to trade it. So that could be a good play moving forward. It's way cheaper than the QQQ. But if you like options like I do, I would probably do something along these lines. If we come back to these lows, it's pretty cheap for me to say, okay, I'll buy a call and I'll sell a put, and that's a synthetic. So this is my risk. I take the ownership right there. There is unlimited risk to the downside, but if I can, kind of time the bottom, it's like owning 100 shares. And it's far more cost effective that way than it would be just to buy the QQQ. So just options. Advanced decline line above the 50-day, watching this as well. If we get another opportunity, and this could certainly happen in 2025, if this market breadth indicator comes back down to lows, that to me is going to be my timing indicator to get long. So S5FI, NDFI, those are the NASDAQ, S&P above the 50-day moving average. Okay, stocks, currencies, Uber. Got some good profit running on Uber. They have earnings next week. I did close up some profit on Uber. I don't know if I have any exposure left on it. My Uber is gone. So yeah, I closed out all shares. It was a ratio spreads. I think that's what I did on Uber. It's in here somewhere. I think I closed that last week, actually. I was up like 85 or 90% of max credit, so I went ahead and just took it. Uber. Look at the history here. Uber the last 30 days. There we go. So a little income trade of $98. And then over the last 120 days, some Uber, $600. So yeah, I mean, it was pretty good to me. One of many. All right, let's get currencies and I'll wrap it up here. Let me make sure I'm not going over on my calendar today. I'm good. Okay. All right, let me get some currencies really quickly. Today, Aussie on top, New Zealand on top, Swiss at baseline, Japanese yen. Not a ton of volatility, but decent. 70 and 80. Dollar certainly weaker. Some risk appetite coming out of China flows. So Aussie, New Zealand doing pretty well. Let's go Aussie CAD. I'm just going to power through these for probably about 5 minutes. Aussie CAD, I'm still long, holding long. Aussie Swiss, I'm still long, holding long. Aussie yen, if you're still holding long, it's same thing with New Zealand yen. If you had the courage to buy the August 5th bottom, small to kind of average into it, it's working out nicely. CAD yen was my favorite yen trade as far as the structure. Aussie New Zealand also looking better. I'm holding that one long. Aussie dollar, no trade. I know it's drifting higher, but even if the Aussie drifts higher, I think a pullback here, looking to kind of dollar cost average into this open space. If we get a pullback, this to me would make some sense, right? We go a little bit higher. Everyone that buys high gets a retracement, so they're going to lose out or they're going to be dealing with a drawdown. I like buying it in here, in here, in here. Be willing to take the swing trade. Just don't chase. I mean, if you're learning anything in currency trading, buying highs and selling lows of currencies is a terrible strategy. I never do it. Like I've passed on more trades because I'm not buying that. I'll wait for a dip. I'll wait for a pullback. I'll wait for a bull flag. Anything. Just don't buy highs. Don't sell lows. It's a terrible trade. Like Forex is such a liquid market. It'll test a high, pullback. It'll go to a high, it'll pull back. Like there's always pullbacks in Forex. CAD Swiss, still holding long, looking for a bottom. CAD yen, maybe this carves out a nice low. If we have this structure here, I still think there's some more upside. If it just breaks and goes higher, we could break here, pull back, still go higher. Again, this is all risk on type trading if the flows look pretty solid for that. Swiss yen, I'd stay out of that one. Euro Aussie, I'm not getting the pullback that I want. This just slides lower. I'm not selling lows. I'm not going to chase it. Euro CAD, I do like this trade. If you're selling Euro CAD, area 1, sell again at the highs. I think this trade still gets down to like 5,400. So there's still some room to go. If it pulls back a little bit, I like this area to sell Euro CAD. Euro Swiss, still holding long. Euro pound, nothing. Euro yen, nothing. Euro New Zealand, not really pulling back like I'd like. I wanted to sell it at that 50618 zone. If it just keeps sliding lower and lower and lower, I'm not going to sell the lows. But the best thing you could have done here would have been like basically taking a stab at these highs, and that's always difficult when the thing's up 1,000 pips. Euro dollar, I liked long euro dollar, but back here. I'm sorry, it's not long. I like short euro dollar back in here. If you're going to short this thing, area 1, area 2, even if it's a chop zone, if we go from this high to this low, I still think the euro dollar, we get a chance to like average into it. We can still hit like a 112 target or lower. I mean, this is a pretty clean fib from low to high. So pull back to like, 1050 makes a lot of sense. 1150 makes a lot of sense. If you're already short, that's fine. But I wouldn't have a tight stop loss. I'd say this area to then reselling the highs, I'd be, stopping out above those highs by about 1 ATR. Pound Aussie, again, breaking lower. I didn't get the pullback that I wanted. Pound CAD, I was trying to sell this one at the highs. I like Euro CAD better. Pound Swiss, it's okay. I think this pulling back to a pocket is a good spot. Averaging in area 2, if you're willing to kind of ride this out with small trade sizes, this is likely going to be my profit zone up in here in these pockets. So target 1, target 2 on pound Swiss. Pound yen, no trade. Pound New Zealand still, retesting, kind of noisy. Pound dollar, keep an eye on this one. This one might surprise us. I didn't like the pound dollar, but if we keep doing this could be an okay trade for a top to form and then a break back down on the right-hand side. But don't give it too much. I would say if you're selling highs, maybe one ATR higher for a stop loss, just don't put a stop loss immediately at a high. That's like the recipe for disaster for Forex trading because they'll poke those highs. New Zealand CAD still long, New Zealand Swiss still long, New Zealand yen. If you courageously bought that August 5th bottom, over here back in the April dip, New Zealand dollar, I'm still thinking we pull back a little bit more. Maybe just working our way back a little bit, just draw a fib from low to high, try to look at a zone in here to buy. And the nice thing is if this just breaks a trend line, open space trading to 63.70 is pretty good. Dollar CAD just kind of slowly drifting lower. Don't love it. Dollar Swiss, still going to hold my dollar Swiss longs into the 87.50 zone. And then dollar yen. If you're hanging on to this trade, this is a strong bottom. So maybe just a little chop and then higher and then chop and then higher. I think this probably gets into like the 148, 149 handle for now. So, all right. I'll wrap it up there. Happy Friday, everybody. Good stuff. Good trading. Have a great week. The heck was that? Oh, credit. Okay. Have a great weekend, and see you later. All right, bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. All month long, you can get the Edge Finder 40% off, our best discount of the year. Check out the links in the description below to visit the Edge Finder homepage or speak with a team member directly to get the 40% off discount now. Trade safely, and we'll see you tomorrow.